Good morning and welcome to docket number 250103, Pura's annual review of the rate adjustment mechanisms of the Connecticut Light and Power Company. We are here this morning for an evidentiary hearing in phase 2 of this matter, and we have an agenda in front of us for this morning. We'll begin by taking any administrative matters from the company or other parties and interveners.
Good morning, Commissioners. Lauren Bidra on behalf of the Connecticut Light and Power Company. Two administrative matters related to the agenda. We have two listed witnesses that are not in attendance today. The first is Douglas Horton. Marissa Peruta and Michael Shelnitz will be covering for Doug Horton. And the second is Warren Booten, and we have Aaron Roy covering for him.
Thank you. Anything further, Attorney Bidra?
Nothing, thank you.
Thank you. Any other party or intervener? Seeing none, I'll move into the swearing in of witnesses. If the company could please introduce the witness panel and identify any witnesses that need to be sworn, please.
Yes, Chair. We have 6 witnesses that need to be sworn in today that were not here on March 14th of this year. So I'll ask those 6 witnesses to please come forward with their name tags. And for the record, the 6 witnesses to be sworn in today are Stephen Lamontagne, Mark Simpson, Craig Dykman, Matthew Carrera, Aaron Roy, and Kelly Sikorsky.
Okay, thank you. If those witnesses could please raise your right hand, I'll administer the oath at the conclusion of the oath. If you could affirm by saying I do. I swear to tell the truth, the whole truth, and nothing but the truth under pains and penalties of perjury. Thank you. Attorney Bidra, anything to the witnesses can please be seated. Any matters to adopt before we move into cross-examination?
Yes, Chair. The witnesses will adopt their discovery responses filed since the March 14th, 2025 hearing. I'll start, if it's okay, Chair, with the witnesses who were just sworn in.
Oh, I told to sit down. I'm so sorry. So those witnesses will need to reapproach. Apologies.
And we'll start with Mr. Roy. Mr. Roy, please state your name and title.
Aaron Roy, cost analyst on behalf of Eversource.
Are you familiar with the company's response to CAE 50 sponsored by Warren Booten?
Yes, I am.
Do you have any changes to this interrogatory?
No.
Do you adopt this interrogatory as your sworn testimony under oath?
Yes, I do.
Thank you, Mr. Roy. Steve Lamontagne, please. Please state your name and title.
Stephen Lamontagne, Director of Distribution Engineering.
Are you familiar with RSR 5, RSR 6, RSR 10, and RSR 11 filed by David Glady?
Yes.
Do you have any changes to those interrogatories?
No.
Do you adopt these interrogatories as your sworn testimony under oath?
Yes.
Thank you. I'll have Mark Simpson. Please state your name and title.
Mark Simpson, Senior Analyst, Power Contracts with Eversource.
Are you familiar with BTP 001 filed by Parker Littlehale?
Yes.
Do you have any changes to this interrogatory?
No.
Do you adopt this interrogatory as your sworn testimony under oath?
Yes.
Thank you. Matthew Carrera, please. Please state your name and title.
Matthew Correa, Procurement Manager, Strategy and Performance.
Did you sponsor any interrogatories that were submitted after the March 14th, 2025 hearing in this docket?
Yes.
Do you have any modifications at this time?
Yes. As part of Pura Set 11, the file Q RSR 008 Attachment 3 contains an incorrect contract reference. The document currently references contract CW 2301078, but it actually pertains to contract CW 2264714.
With those modifications, do you adopt those materials as your sworn testimony under oath?
Yes.
Thank you. Mr. Dykeman, please.
Good morning, Craig Dykman, Vice President of Supply Chain and Property Management.
Did you sponsor any interrogatories that were submitted after the March 14th, 2025 hearing in this docket?
Yes.
Do you have any modifications at this time?
No.
Do you adopt those materials with the modifications specified by Matthew Carrera as your sworn testimony under oath?
Yes.
Thank you. And one final witness out of the ones who were just sworn in, Ms. Sikorsky. Please state.
Go ahead. Sorry. Kelly Sikorsky, Director of Regulatory Financial Analysis.
Did you sponsor any interrogatories that were submitted after the March 14th, 2025 hearing in this docket?
Yes.
Do you have any modifications at this time?
No.
Do you adopt those materials as your sworn testimony under oath?
Yes.
Thank you.
Thank you.
Chair, I'll proceed to have the witnesses adopt their interrogatory responses that were filed after the March 14th hearing, if that is okay. Thank you. I'll go in order of the table, starting with Mr. Shelnitz. Please state your name and title.
Yes, my name is Michael Shelnitz. I'm a manager of revenue requirements for the Connecticut jurisdiction.
Did you sponsor any interrogatories that were submitted after the March 14th, 2025 hearing in this docket?
Yes, I did.
Do you have any modifications at this time?
No, I do not.
Do you adopt those materials as your sworn testimony under oath?
Yes, I do.
Thank you. Peruta, please state your name and title.
My name is Marissa Peruta, and I'm the Director of Revenue Requirements for Connecticut.
Did you sponsor any interrogatories that were submitted after the March 14th, 2025 hearing in this docket?
Yes, I did.
Do you have any modifications at this time?
No, I do not.
Do you adopt those materials as your sworn testimony under oath?
Yes, I do.
Thank you. State your name and title.
Laura Purbeck, Manager of Wholesale Power Contracts for Connecticut.
Did you sponsor any interrogatories that were submitted after the March 14th, 2025 hearing in this docket?
Yes, I did.
Do you have any modifications at this time?
No, I do not.
Do you adopt those materials as your sworn testimony under oath?
Yes, I do.
Thank you. Mr. Davis, please state your name and title.
Edward Davis. Thank you. Edward Davis, Director of Rates for Eversource Energy.
Did you sponsor any interrogatories that were submitted after the March 14th, 2025 hearing in this docket?
Yes,
Do you have any modifications at this time?
I do not.
Do you adopt those materials as your sworn testimony under oath?
Yes,
Thank you. Please state your name and title, Mr. Bruno.
Stephen Bruno, Director of Connecticut Energy Efficiency for Eversource Energy.
Did you sponsor any interrogatories that were submitted after the March 14th, 2025 hearing in this docket?
Yes, I did.
Do you have any modifications at this time?
No, I do not.
Do you adopt those materials as your sworn testimony under oath?
Yes, I do.
Thank you. We have about a handful of witnesses left that I'll ask to approach. I'll start with Daniel Trainer, please.
Good morning. My name is Daniel Trainer. I'm the Director of Collections and Assistance Programs for Eversource.
Did you sponsor any interrogatories that were submitted after the March 14th, 2025 hearing in this docket?
Yes, I did.
Do you have any modifications at this time?
I do not.
Do you adopt those materials as your sworn testimony under oath?
Yes, I do.
Thank you. And I'll call the remaining witnesses up so we can go one by one. Mr. O'Brien, Ms. Landry, Mr. Toronto, Mr. Bajan, and Mr. Rice. We'll start with Mr. O'Brien once he gets up. Oh, that's fine too. Please state your name and title.
Brendan O'Brien, Director of Revenue and Regulatory Accounting.
Did you sponsor any interrogatories that were submitted after the March 14th, 2025 hearing in this docket?
Yes, I did.
Do you have any modifications at this time?
No, I do not.
Do you adopt those materials as your sworn testimony under oath?
Yes, I do.
Thank you. Please state your name and title, Ms. Landry.
Good morning. My name is Leanne Landry. I'm the Director of Investment Planning.
Did you sponsor any interrogatories that were submitted after the March 14th, 2025 hearing in this docket?
Yes, I did.
Do you have any modifications at this time?
No, I do not.
Do you adopt those materials as your sworn testimony under oath?
Yes, I do.
Thank you. Mr. Toronto, please. Please state your name and title.
Jeff Toronto, Manager of Budgets and Investment Planning in Connecticut.
Did you sponsor any interrogatories that were submitted after the March 14th, 2025 hearing in this docket?
Yes, I did.
Do you have any modifications at this time?
No, I do not.
Do you adopt those materials as your sworn testimony under oath?
Yes, I do.
Thank you. Please state your name and title, Mr. Bajan.
Good morning, I'm Bernie Budgeon, and I'm manager for the Credit Contact Center Vendor Management for Eversource.
Did you sponsor any interrogatories that were submitted after the March 14th, 2025 hearing in this docket?
Yes, I did.
Do you have any modifications at this time?
No, I don't.
Do you adopt those materials as your sworn testimony under oath?
Yes, I do.
Thank you. Last but not least, Mr. Rice, please.
Good morning.
Good morning. Please state your name and title.
My name is Brian Rice. I'm Director of Customer Solar Programs at Eversource Energy.
Did you sponsor any interrogatories that were submitted after the March 14th, 2025 hearing in this docket?
I did.
Do you have any modifications at this time?
I do not.
Do you adopt those materials as your sworn testimony under oath?
I do.
Thank you, Mr. Rice. Commissioners, that completes the swearing in of all the witnesses and their adoption of interrogatories filed after March 2025. The panel is now available for cross-examination.
Thank you. We will begin cross today with the authority staff, and I believe first up we have Mr. Norton, please.
Morning. Thank you, Madam Chair, Commissioner Arconti, and Commissioner Karen. Good morning, panel. My name is Jonathan Norton with authority staff. My questions this morning will align with, or some of the topics I'll be covering for the panel are locational marginal prices, the update provided by the company there, full-time equivalencies within the NBFMCC for the clean energy and grid modernization programs, some miscellaneous NBFMCC costs, and then some questions on some variably priced contracts held within the NBFMCC toward the end. So I'll begin on the LMPs. Specifically in reference to interrogatory response RRU 10. So for the LMP impact to the purchase power agreements, is it correct that the company's response in this interrogatory indicates that the partially actualized LMP forecast is expected to produce approximately a $228 million net benefit to ratepayers in 2025 when compared to the 2024 actual net cost for those PPAs?
That's not the actuals, that's your projection. Mr. Norton, would you restate the question, please? So sorry.
Is it correct that the company's response in this interrogatory indicates that the partially actualized LMP forecast, as provided in the interrogatory, is expected to produce approximately a $228 million net benefit to ratepayers in 2025 as compared to the 2024 actual net costs for PPAs?
So in the response, we have the forecast and the actuals to date. So that is correct. That is the amount for when you compare to your LMP forecast as of May 2025. For the full year, starting May 1, 2025 through through December 31st of 2025.
Right, so the first 4 months, January through the end of April, actualized data The remainder is a forecast, and the company is specifically in that response forecasting that there'll be $228 million as a net benefit compared to what happened in 2024.
That's correct.
Okay.
Could I just quickly, just for the record, that is truly compared to what happened in 2024, but not what's included in the May 1, 2024.
Right, and I was gonna clarify that. So that would mean because the interim decision in this proceeding accounted for 142 million of that balance, there would be 86 million of potential net benefit, assuming that this forecast materializes through the end of the year.
That's correct.
Understood. Thank you. Can the company provide a supplement to RRU 10 that actualizes through the month of May?
We can, but we would need to make sure that our books are closed. What time would you need that supplement by?
I think mid-June would be, June 13th would be great if you could meet that date.
Is it possible to do the 15th? I haven't looked at a calendar. Is the 13th like a,
The 13th is a Friday, the end of that week.
we can aim for the 13th if that's okay.
Okay. Thank you. Does the company support the inclusion of the actual net cost effects to the PPAs for the January 2025 through May 2025 period as a result of only the actualized LMPs, the net impact of those to the PPAs being incorporated for a September 1st NBFMCC rate adjustment?
Yes, the company has no objection to that, should Pura choose to do that. However, I would like to add that given that there is still an entire interim calendar year period that is open, that the company would request if there are any significant material changes that do happen in the energy supply market that do result in actuals coming in significantly higher or lower, that we have an opportunity to provide it to Pura.
Okay, thank you. I can continue. I'm going to move away from the LMPs onto the full-time equivalencies within the NBFMCC. And my first reference I want to make is to the company's January 15th known and measurable filing, specifically the pre-filed testimony in Exhibit 1. And I'm specifically looking at page 81, which includes Table 2, showing which displays the NBFMCC RAM full-time equivalencies of 26.5 actual FTEs incorporated in 2024, as well as a projection for 2025 of 31 FTEs. So with that in mind, Table 2, could the company specifically provide an update on whether the additional positions expected to be filled in 2025 have been filled or not?
First. Yep. Hi, good morning, Steve Bruno. I'll speak to the two of the grid mod programs, the IES program, and then also the ESS program. Essentially, both of those programs to date, we have not added bodies to, FTEs to. We've been managing with existing staff. So we have the forecast that was included for 2025 with expectations to hire additional resources, but we have not hired that. We've been able to manage with existing resources. So we can provide an update if needed for a better forecast.
Okay.
Programs.
Yeah, I'm gonna request an update further down in my line of questioning, but how about the other programs listed within Table 2 there? Because I think it was beyond just the IES and ESS programs.
Oh, sorry, I can also finish up the questioning on the EV electric vehicle program. We have not added additional resources yet. We're in the process of transitioning. We were using a third-party vendor to review some of the applications. We're bringing that work in-house. So those are still under development. But so we're still roughly at the same count as prior in 2020 and 2024, the 6.1. So the additional 2.3 are not hired yet.
Okay, so am I clear then in your response indicating that as of right now for the clean energy and grid modernization programs that as of today, the company is still at 26.5 FTEs as reported in 2024, or is it higher than that?
So for the ESS program, innovations pilot, and the electric vehicle, we're on track with that same numbers as 2024. And I'll let Mr. Rice comment on the other ones.
Yeah, for the Connecticut residential solar, as well as the Connecticut commercial solar, the headcounts, which were unchanged from 2024 to 2025 projections, continue to remain unchanged.
Okay, thank you. For the positions that you had mentioned that aren't filled yet, that were projected for 2025, shown in table 2, can you provide just what those titles are and for which specific programs they apply?
For the electric vehicle program, we were adding additional analysts to support the review of the project work. And so those are at the senior analyst level. And then for the innovations pilot, those aren't posted yet as we've been waiting to see what the work requirements are from the pilot programs that are coming through. So we're able to manage the existing process. So there are no postings for those two, for the innovations pilot program right now. And the ESS is just no additional postings, but additional time from existing resources that are not in rates that may charge the program. We've been able to manage with the existing staff as well.
So you specifically mentioned aren't in rates, so what was presented in table 2 up to the 31 FTEs across these programs were not necessarily included in known and measurable filings for January 15. Realize that's a broad question across from programs.
Yeah. So yeah, those are in rates right now, correct?
They are.
Yeah.
I think you mentioned at least for a couple of the positions already, but for all the positions not yet filled or not even yet posted, well, sorry, for the positions that have been posted and not yet filled, could you just provide how long those positions have been posted for?
Okay. Sure. Do that in a late file.
I would just like to add that, when we reconcile the end of the year costs, to the extent a position has not been filled, that will show up in that end of period reconciliation. So it will result, to the extent it was in a known and measurable, it will result in an over recovery. There will be other under recoveries as well throughout the filing. And so that will all work out in the final reconciliation of the 2025 costs.
Understood. I'm going to continue on, but on the point of that request on how long they've been open, I think I might just alter my my request for a supplement on this topic, and maybe it can be included in there. I'll be getting to that. But moving further along, I want to drill down into the company's response last year, actually in 240103. The company provided a supplemental response to CAE2 from 240301 docket, or sorry, 240103 prior year RAM docket, which estimated roughly 23.4 FTEs. And if you need a minute for me to point out that figure for you, I can certainly wait if you want to try to pull up that prior year filing. So so I was looking at that supplement to CAE2 column G, which showed the percentages expected in 2024. I just took the sum total of those, getting to the approximately 23.4 FTEs that the company was expecting to be at in 2024. Maybe you can confirm if you're following me on that figure.
I don't have the totals. I have the salary, the percentages, but I don't have the total.
Okay.
See if I have.
But you're following column G, which shows that those percentages by role that was provided.
Percent of involvement, correct?
That was anticipated, yep. So that's where I'm getting that 23.4 as a total FTEs across the clean energy and grid mod programs, if you sum that down. And so my question is if the company could just provide some clarity on the discrepancy between the original estimate provided here and last year's RAM proceeding versus what we were just looking at in table 2 of the current year's pre-filed testimony, which showed the 26.5 actual FTEs and what the increase was for. Um, so I guess we can we could roll that into I guess my request here. So let me provide some clarity here. So the end result of this, which I should have put on the front end, is as a late file, I want to request an updated version for this year of what was provided in last year's CAE2, the supplement that the company provided. If we could get another list showing all those positions by the clean energy and grid modernization programs, showing that actual 2024 percentage and then the projected 2025.
Makes sense.
Along with some of the questioning that you have also been jotting down that are some, broader answers. Specifically the discrepancy of what the company expected in 2024 last year and what actualized as this year.
Okay, that's late file exhibit number 1.
Okay, I'm going to move on now to interrogatory response CAE 49. In regards to the question C within the interrogatory response, which is in relation to the Schedule 16 Black Start cost line item. The company indicates that certain power generators receive, quote, pooled service payments, close quote, which include, quote, equipment damage reimbursements, close quote. The company comment on what equipment damage scenarios would justify the company reimbursing such expenses to these generators?
I can't comment on what kind of scenario would create a equipment damage reimbursement. All I can say is that ISO New England would be the administrator for that. They're the ones that would determine what is the appropriate level of Black Start payments that are owed to the suppliers of Black Start service.
So then I guess more so just for understanding the relationship that Eversource has contractually with these generators, is the company directly under contract with these generators? Since these are generators that are connected to the transmission and distribution systems, is that right?
That's correct. Eversource is not directly contracted with them. These are resources that provide a service to the New England grid that's administered by ISO New England. That service is the ability to restart the grid in the event of a catastrophic failure. And so that's administered by ISO New England.
And then, of course, any of those costs associated with those generators, in this case, wouldn't flow into transmission or distribution. If it was Black Start related, would flow into this line item held within the NBF MCC.
Correct. Back when the non-bypassable FMCC was started, back in, I want to say, the early 2000s, it was designed to recover the costs associated with ISO New England's standard market design. And this is one of those costs that was contemplated under standard market design.
Thank you. I'm going to move to interrogatory response, CAE 51. In this response, the company states that renewable energy credit sales from Q2 of 2024 were able to be booked as early as January 2025, but could not be booked in actual 2024. Is that correct?
Sorry, just a second. Pulling up the question. So in the 2024 numbers, only 3 quarters worth of rec sales were booked, whereas typically there's 4 quarters of rec sales that are booked in a calendar year. But due to the timing of when those recs were transferred to the parties and accepted by the parties in NEPL GIS, only 3 quarters worth of rec sales were booked in the 2024 numbers.
Okay. Is the company able to provide as a supplement to this just the total credit that was booked in January that I guess should have normally been booked in calendar year 2024?
As it pertains to that specific line item?
Yes.
Yes, we can provide that as a supplement.
Okay. Thank you. Did the company present a known and measurable adjustment for 2025 for the fact that 2024 only included these 3 quarters worth of rec credits?
Subject to check. I don't believe so. No.
Okay. Is there any
So, yeah, that's correct. We did not book or provide a known and measurable for this, but I don't think that by January 15th, the numbers were known at that point either. So
Gotcha.
there wouldn't have been a way to do that.
Understood.
And if I could just add, Mr. Norton, just quickly on should have been versus were. If you look in the response, the transaction, once it is fully complete and is fully known, that's at the point in time when the energy supply team and the responsible subject matter experts record it to the general ledger system. So it is likely, as Ms. Parvac indicated in her response to this discovery, where we state the transaction is fully complete before booking the resulting credit, it would not have been received in time to record when the books were closed in January of 2025 for the December 31, 2024 year-end close.
Gotcha. Maybe, I mean, we could potentially forego the supplement to the interrog. I don't know if it's easy enough if that number is in front of you, what was actually booked for the credit. If not, it's fine.
No, I don't think I have that handy, the specific amount of the credit.
Okay, that's,
You mean just for the rec sales that were booked?
yeah, the credit that would have been, in our proxy actuals for 2024 that that would have, I guess another question I have, is how long does it typically take them to close the books for these rec sales? Like, because we have, seems like the year-end credit can fall between different years. So what's the traditional turnaround time on closing the books for those?
Yeah, so just to clarify the closing of the books, so the transactions are booked by Eversource when the counterparty who we're selling them to accepts them in NEPL GIS. And so typically toward the end of the year, I think likely because of holidays and people's vacation schedules and stuff, sometimes the people who are in charge of the NEPL accounts on the other end, on the buying end, just don't accept them until, later on in the year or early in the following calendar year, which then books or allows our team to book that transaction in the following calendar year. Whereas, typically we would account for it in like the December-ish timeframe.
Yeah.
And so it's not necessarily our team, it's not always our team closing our books. It's just whenever that transaction is complete in NEPL and the counterparty that we're selling to has accepted them, then we book it because the transaction is fully complete, and then we book it as the credit to our accounts. So it is pretty typical for those to, especially toward the end of the year, flow from, the end of a calendar year into the following calendar year. And I think we've had that situation happen and explained it in the attachment, and I'm picturing it in my head where we explain 2023 versus 2024 changes. It's very typical for us to say, that it's because of the timing of rec transactions being booked, et cetera.
Okay.
And just to add, Mr. Warren, that same trend and set of circumstances occurred in 2022 to 2023 in that year end, where the December we'll say in circumstances where it is received in time for Eversource's books and records to be closed for the year end 2022 close was received not in time for the Eversource team to complete that to the general ledger system. So it was recorded in January of 2023. And thereby it was picked up by the revenue requirements team in the 2023 RAM calendar year.
So it's likely that this is a scenario where it isn't always known where it's going to fall. Okay.
Correct.
But maybe one more question on the timing, because these credits were from Q2 2024 based on what the interrog response says. So is that 6-month kind of gap pretty common for the sale of these recs?
Yes, it follows the NEPL GIS schedule, which is typically on a 6-month delay. So typically in a calendar year, I believe it's where you're typically booking from January to December, Q3, Q4, Q1, Q2. And I'm looking at Brian. I think that's the correct pattern of how it.
Typically, but in this case, you had Q2 as well from the prior year. Or maybe I heard you wrong. You said Q3, Q4.
Yeah, so typically in January-ish timeframe, you're booking Q3 of the prior year's rec sales because of when they're created in NEPL GIS in accordance with the NEPL GIS schedule, which is on a 6-month delay.
Okay, got it. So then for 2025, at least, it's either going to be, it's expected to be either 4 or 5 quarters worth of recs, because that last one could effectively fall in December if it closes, but you don't officially know.
So it's not necessarily 4 or 5 quarters. It also depends on how many PPAs and what the amount of RECs that are sold, and then that transaction specifically, because the team that handles our REC transactions sells them in various quantities. And so it just depends on which RECs from which projects they're selling and in what quantity. So each transaction is separately booked. So for example, if a project in this line item for Public Act 13303, if that contract generated, say, 50,000 RECs, 25,000 of those may have been sold in one transaction. And if that entity who's purchasing those RECs doesn't accept them in NEPL GIS until January 30th of the following year, then that specific transaction of 25K and whatever the resulting credit is what would then be pushed to being booked in the following calendar year, as opposed to being booked in 2024, if that makes sense.
Yeah, that makes sense. Thank you for the detailed response. I'm gonna kind of broaden my questioning here, but still on the Public Act 13-303 topic. For these projects, does the company also procure and sell the energy similar to some of the other PPAs? And
Under those contracts, yes, we purchase energy and renewable energy credits.
and then it's resold by the company?
The company doesn't manage those transactions, but it's settled via ISO New England, and we receive our buyer's percentage entitlement portion of the proceeds of that transaction that occurs at ISO New England.
Right, understood. For these projects, same projects, is the energy purchased at a fixed or variable contract price?
I would have to look up the contracts individually. But all of our contract pricing is provided in the clean and renewable energy docket. Hang on one second, I have it here. This year, for 2024, it was docket 240801 in response to CAE 006. Each of our contracts and their associated pricing is included in there.
That's all the contracts it would include all the contracts and held within the NBFMCC?
All of the power purchase agreements that my team administers are included in that response, yes.
If they weren't technically power purchase agreements that had, some type of non-fixed contract price, would that listing be included? Would it include those type of contracts as well, or just the PPAs?
So all of the contracts that my team administers are noted individually on line by line in that response. So any of the agreements that are under my purview are listed there, and so are their associated pricing year over year.
Okay. Are there other groups that handle, well, maybe I'll go back with one question. Are there any variably priced contracts in the NBF MCC that are selling energy to the ISO New England market?
Yes.
Okay. And are there other groups within Eversource handling those types of contracts other than what you manage?
So the power purchase agreements that my team manages typically include language in the contract itself that states that the energy is settled via ISO New England, and then that we receive our buyer's percentage entitlement of the proceeds of the energy transactions that occur at ISO. But our team and our company specifically is not responsible for managing the bidding into the day ahead or the real-time energy markets, though that is handled by the facility itself.
Got it. Um, Could I request, maybe as a supplement to CAE 51, if that's appropriate, or since it's kind of broader, it could potentially be a late file. I think it would be enough to bring in that list that you had referenced, from I think you said 240801. But I would just maybe make a request just to clarify within that list, that all the contracts, including any potential variable priced contracts that are held within the NBFMCC, be included if they weren't. Is that clear what I'm getting at? Or
Yeah, so I just want to make sure that we're responsive to the question. So I believe, and if I have a minute, I'll go back and take a look at what that specific question in that docket is. Because again, it should be a complete list of all of the PPAs that we've entered into as a result of deep procurements. So I'm not sure if there's like any other specific category of contracts that fall within the non-bypassable FMCC that you're requesting information on, because I can only speak to the ones that I manage. So do you have a specific contract or example that you can refer to, and maybe we can see if we can?
yeah, so it's my understanding that typically the PPA contracts are all fixed prices, right? That Eversource is purchasing energy for, or some of those variable.
So there are agreements that have variable pricing, and mostly it's the fuel cell contracts that we have. But I believe there may be a few others, and it just depends on the deep RFP itself and whether or not it allows variable pricing. But typically the fuel cell contracts do have a variable pricing component because they're based on, or a portion of the calculation is based on natural gas prices.
Right. Yeah. So I guess my request would be PPAs or non-PPAs that are within the NBFMCC that Eversource is procuring energy and or RECs for, that energy is then getting settled in the ISO New England market. If we could get a full list for the NBFMCC, all of those.
Okay.
I think that's a proper LFE request, since this kind of is beyond the interrog at this point.
Yeah, so I think that the data response that we filed in that other docket will likely cover that. So,
Okay.
Thank you.
Okay, so it's late file exhibit two.
Thank you. And then just two more questions I have on this topic. In general, what criteria does the company use when deciding to liquidate the energy into the ISO New England market as it relates to these contracts within the NBFMCC?
The company doesn't liquidate the energy. It's the transaction happens via ISO New England, and it's settled via ISO New England, and the counterparties are responsible for managing that. And then we receive a settlement from ISO New England based on our buyer's percentage entitlement.
Okay, thank you. think that's all I have, although I wonder, I guess I would be curious to know within the LFE2 request that I just made, if it would be possible for you to potentially put like a yes, no column or something on whether individually each one of those contracts were included in the RRU 10 interrogatory response, which gave us the updates to the effects of the LMPs through the rest of the year.
Yeah.
If I need to restate that, I can.
No, I understand what you're asking. So you want to make sure that it's a complete list, that every contract that was included in RRU 10 was also included in the CAE 6 that was filed in the prior
Yeah.
docket.
And if it isn't, that's fine. I just want to know what those contracts are and maybe why, a simple note why they wouldn't be incorporated into, a forecast that the company's providing for the effects of the LMPs.
Sure. So I think RRU 10 specifically asked for anything that was included in the 2024 timeframe. And so if a contract either was not online or had terminated, then it wouldn't have been included, because if there were no costs associated with it, it wouldn't have been, we wouldn't have listed it as having a dollar value assigned to it.
Yeah. And that would be fine with me as a note.
Okay.
Before I step away, I also want to clarify one thing on LFE 1, which was in relation to the FTE list of FTE requests. Just to ensure that the list provided also includes that also trues up to the table 2, where the company had presented 31 FTEs for 2025. Just want to ensure that that comprehensive list with the positions listed out include any of the positions that have not been filled, have not been posted yet, that it's a full comprehensive list on that ties back to the 31 FTEs that the company originally proposed in January 15th. Okay, that's all my cross. Thank you, everyone.
Briefly, Mr. Norton and commissioners, I would just like to verify the supplement to make sure that our notes are all the same. I have the 2 late filed exhibits, and I believe just one supplement, because the supplement to CA 51 will be encompassed in late file 2. Is that correct?
I believe that's correct. I'm just checking my notes very quickly.
No, so.
So the first supplement I requested was to RU 10 as an update to the LMP forecast. And then the second was in relation to the rec credit that was booked in January, that actual amount, and then the 2 LFEs.
Can I just clarify on the first supplement, do you just want an update to the forecasted LMPs? Is that all that you want updated?
What was provided in RRU 10 essentially refreshed for May actuals.
So all of the attachments.
Yes, I think
Okay.
there was only one, but yes,
Okay.
Thank you.
of course.
Thank you. Mr. Arpin, please.
Apologies, Mr. Norton. One more clarifying question. Are you looking for a reforecast of the LMPs as well as of June?
Yes, please.
Okay. And is it okay if we cut it off at June 10th or something so that we can,
For like a partially actualized June.
right?
Yeah, latest available info, I think is it.
Forecast.
Yeah, the forecast can be a partially actualized.
As of the forecast reported on June 10. So it'll be a couple of days delay, it'll be a couple of days stale
Yeah,
in order
yeah.
for us to get it on the record. Okay, and that'll be for the June through December of 25 forecasted LMP pricing.
Yep.
Implications. Okay,
With
thank you.
actualized through May.
Yes.
Actualized through,
Actualized through
yes,
May.
actuals through May, and then the rest will be a forecast.
Thank you.
Thank you, sorry.
Thank you, no worries.
Good morning. My name is Christopher Arpin, and I'll be handling questioning primarily for the SBC today. Just give it a moment in case anybody needs to swap seats. So my first question, so according to Exhibit H14, LiDAR IT capital revenue requirement, Eversource appears to be capitalizing IT costs relating to the LiDAR program. Could Eversource please provide an explanation for why these costs are being classified as capital expenditures rather than operating expenses? And specifically, could Eversource please outline the applicable accounting and rate procedure standards that support the capitalization of these costs?
Can you just repeat the question again?
Sure. Yeah, Exhibit H14, Eversource appears to be capitalizing IT costs relating to the LiDAR program. So I was wondering if Eversource could please provide an explanation for why those costs are being capitalized.
Sure. So those, they're being capitalized because they represent system upgrades that are required to provide the LiDAR billing functionality. So those would be not considered operations and maintenance expense. Those would be actual upgrades to the infrastructure, to the billing system.
Okay, thank you for that response. So another question on that topic. So per CAE 57, Eversource's LiDAR IT capital costs are broken down in the subcategories such as internal labor, contractor labor, and IT services. Could Eversource please confirm whether all LiDAR IT implementation costs, including internal labor and IT services, are being capitalized through the SBC? And if not, could Eversource please clarify which specific LiDAR IT implementation costs are not being capitalized?
Sorry, Mr. Arpin. I was struggling to get to the actual exhibit attachment one for CAE 057. Would you mind just repeating the question? I want to make sure I answer it correctly.
Yes, my question is whether all LiDAR IT costs are being capitalized, including internal labor. And if not, which LiDAR implementation costs are not capitalized?
Okay, thank you for repeating that. I appreciate that. So in capitalization criteria, there are internal labor costs that meet the requirements for capitalization under GAAP, FERC accounting rules. So there is internal labor that is used. Those are the subject matter experts within our IT organization and those billing employees that have a specialized skill set within the IT organization that rely on the SMEs to actually work on the billing system implementation and upgrade, as Mr. Shellens referred to. So that is the internal labor that is recorded to the work order that is set up specifically for the lighter IT billing upgrade. And therefore, it's tracked in this manner. So it's brought into the capital work order, and that's how our department pulls it in. We grab the work order for this specific project, and then we create the revenue requirement for it in order to put it into the RAM rates. I hope that's helpful.
Yeah, thank you. And so just to confirm, so all of the LiDAR IT implementation costs are being capitalized currently?
I wouldn't say all. I would say those costs that fall under the accounting rules as being allowed to be capitalizable. There could be IT implementation costs that happen while the IT billing system is upgraded that aren't necessarily part of the capitalization project. So those would be standard regular O&M costs. But anything that would meet the requirements of the project upgrade would be capitalizable.
Thank you. Could Eversource please confirm whether the internal labor costs in support of LiDAR IT implementation are not already being recovered through an account in base distribution rates if they're being recovered through the SBC?
So typically, when the company files its base distribution rate case, there is a capitalization portion of labor. This would be picked up. This would probably be, and subject to check, it would probably be the IT personnel, and those are shared service company employees. So shared service company employees that are picked up during a base distribution rate case would only be those shared service company employees that are recording O&M. So that's the only component that would be picked up. So during a base distribution rate case proceeding, the company provides a test year. That test year has a representative amount of shared service company employees that work on O&M and shared service company employees that work on capital, which is not included in your cost of service. This portion would relate to the shared service company employees that typically work on IT capital infrastructure that is capitalized. So to answer your question, I know that was long-winded, no, it would not be. There would be a representative amount that is not included in base distribution rates.
Okay, thank you for that response. And you may have answered this a little, but just to clarify, so how does Eversource ensure that internal labor costs are not being double recovered? Could you just describe a little more the company's internal controls and accounting procedures that would prevent such duplication?
Double recovery in terms of what's sitting in base rates?
Yeah, in terms of base rates, like the internal labor and base distribution rates versus the SBC specific project.
Yeah, let me just confer with Mr. Shellens. Thank you for that pause. So again, when the company comes in for a base distribution rate case, there is a representative amount of shared service company employees that are allocated and considered as part of the payroll expense that's in your cost of service for shared service employees. In addition, what happens is those shared service employee payroll expenses that are allocated to CLMP are then reduced by a capitalized amount representative of how much in that test year of the total share of service employees that were allocated to CLMP worked on capital projects. So in essence, we reduce payroll labor for shared service company employees who work on capital. And the way that happens is that when shared service company employees work on a capital project, they charge a work order, and that work order is mapped to the balance sheet. So you would not see that come through the income statement. So in essence, our company, when we present a rate case, we already remove a representative level, a proxy, if you will, to ensure that base distribution rates are not recovering costs associated with, let's say, 100% of an individual, because that individual could be working 50% of their time on capital and 50% of their time on O&M. These individuals that were picked up are typically likely employees that work on capital IT projects, upgrades in other areas. So they are likely working on a blend, both capital and O&M related costs. So these employees, because they're being deferred to the capital work order associated with IT, we would have to recognize it as a revenue requirement in the RAM. Otherwise, there's no recovery. Does that make sense?
That makes sense. Thank you. My next question, staying on this topic, I just wanted to confirm that Eversource has capitalized its LiDAR IT costs in other service territories that have LiDAR, such as New Hampshire and Massachusetts.
Unfortunately, I don't have that at my fingertips. If we could take a late file, we'll be happy to provide
Yeah, that would be great. Thank you.
Can you just repeat that, Mr. Arbin? That'd be late file number 3.
Yeah, a late file regarding how Eversource capitalizes its LiDAR IT costs in its other service territories, such as New Hampshire and Massachusetts.
Great, thanks.
My next question, at a high level, could Eversource please describe its current capitalization policy? Specifically, how does Eversource determine whether an expense can be treated as a capital expenditure rather than an operating expense?
So generally, the company would follow the generally accepted accounting principles to which outline generally which costs are eligible for capitalization and which costs are eligible for expense-related treatment. So the company would generally, for all of our books and records, we'd follow the GAAP guidance, and we would also follow the FERC Uniform System of Account guidance as well.
Okay, thank you. I just wanted to...
Mr. Arpin, we do have, I'm so sorry. We do have, Mr. Arpin, we do have Miss Landry who's coming up as well to add to that.
Okay, thank you.
Just realized, sorry, I forgot my name tag. So my name is Leanne Landry. So we also have internal accounting policies that we've provided. So accounting policy statement number 8 that the company has is capital versus expense criteria. And that's also outlines exactly what Mr. O'Brien said, that we follow, that, you know, we follow GAAP rules, plan accounting, we make sure there's units of property associated with those. So that's also, in addition for IT projects, there's accounting policy statement number 3, which has to do with capitalization of software. So in addition, those are the 2 accounting policy statements that we follow as a company that outlines exactly what Mr. O'Brien said.
Thank you for that response. I was wondering if the company could please file that as a late file exhibit, a copy of those accounting policies.
We have filed APS 8, but we could definitely file APS 3, the accounting policy statement. Number 3 is on computer software, so we could definitely do that.
Okay, that'd be great. Thank you.
The accounting policy 8 is in RSR 12.
Okay, thank you. So my next question, so aside from LiDAR related IT capital costs, are there any other costs currently being capitalized within the RAM outside of the ESI rate component?
Can you repeat the question?
Sure. So outside of the LiDAR relating IT capital costs that we had discussed earlier, are there any other costs that are currently being capitalized within the RAM outside of the ESI rate component?
Yes, there are several, and there was a data request that listed them out. But there's the DER portal and DER map in the non-bypassable FMCC. There is another one in the non-bypassable FMCC. I want to say Shrek, but see if we can find the data request.
While the witnesses are looking, commissioners, I wanted to clarify the record with Mr. Arpin. For the accounting policy statement number 3, did you want that filed as a late filed exhibit?
Yes, please.
I believe that would be late filed exhibit 4.
Before.
Thank you.
CC 7. So so the capital recovery that's included within the RAM is shown in OCC 7 and OCC 7 Supplement 1. You can see the individual programs that are being capitalized within the RAM.
Okay, thank you for that response. So I just have a couple of more questions here. So in CAE 58, Eversource updated its 2025 LiDAR cost estimate to reflect the authority's March 19th, 2025 decision in docket number 171203 RE11. The revised estimate projects approximately $105 million in 2025 LiDAR costs, which is roughly $12 million less than the $118 million included in the interim decision. Given this downward revision, does Eversource recommend a corresponding $12 million reduction to the SBC in the final decision? Why or why not?
Yeah, the company would support an adjustment there.
Okay, thank you. And now my final question, and I know that there were some interrogatories on this topic, but the answers were a little unclear to me, so I just wanted to follow up on those. So in Exhibit H, a specific line item on page 2, row 23 reflects cost associated with RRES and ESS additional call handling time. Could Eversource please provide a detailed explanation of how this figure was determined, including the methodology used to calculate the monthly expense required for this cost item?
Is it on? Sorry, can you hear me? Yeah, sorry. So, so I'm Bernie Budgeon, and I manage the contact center vendor management. Now, the methodology for calculating the incremental average handle time for RS and ESS, we did a time study of 378 calls and over multiple months. And then in those time studies, we clocked the time on an average, what the CSRs were talking to the customer, giving them the minimum information, a lot of back and forth, and then we averaged out the time. So it came out to be around 50 seconds. If you average out for, I think we did the time study for close to 10 months, basically over the span of those months, and the average handle time was 50 seconds, which is around 15 FTEs. So that's the methodology we used.
Okay, thank you. And is that study done every year? Redone every year, or is this like an older study?
No, this is done with the new orders that come with us, and this was because this was done. These orders came in like end of 23, beginning of 2024. That time study was done for last year. We continued to do these time studies because over a period of time, the information shared with the customers changed, so it might go up or down. So we'll continue to see how the cost trends, basically.
Okay, thank you for that response. And those are all my questions. So I thank the panel for their time today.
Mr. White.
Thank you. So I have a few questions covering IES, RDM, and uncollectibles, and I'll start with IES. So the gist of my questions, I'm looking at the IES category 1 costs, known and measurable versus actuals. So I was looking at the January 15th compliance filing, Exhibit 21, cell O21 indicates that 2025 would see about $1.4 million of category 1 costs, administrative costs, based on approximately $121,000 of expenses per month. And then if you refer to CAE 55 attachment 1, cells C16 through G16, looking at actual costs for January through April, it's a total of $68,000 or about $17,000 per month rather than $120,000. I know there was some discussion before about FTEs. I'm just wondering what the difference is, what does that discrepancy or disparity represent?
So thank you for the question. The $1.4 million is a combination of labor FTEs, marketing, customer acquisition, and third-party expenses for any evaluations that we needed to support some of the pilot project costs. So right now, the FTEs are running, as mentioned before, they're running below. We're getting by with what we have. The program is still kind of in startup where the pilot projects are coming through. So we estimated what FTEs we need to support it, but right now we don't need that to support for what we've forecasted. So we're running low on the $1.4 million. So if you analyze that, we would be below the $1.4 million based on the FTEs. And also we'll know a little bit more as the pilots progress, whether or not we'll need the additional evaluation support, but that was budgeted in there as well.
The additional valuation?
For engineering support, there's additional outside engineering services are needed to review some of the projects or the technical questions that come up. So those are budget estimates. The 1.4 million, if I can give you a breakdown, it's roughly $800,000 for labor, contract labor about $150,000, and then the rest is third-party support, whether it's evaluation or engineering studies. So we can do a reforecast if you'd like, based on where we are today. But that's what the 1.4 million was based on, unknown estimates of what the pilots would support. We're in cycle 2 right now. Project invoices are starting to come through, but so far the team's been able to respond to the project participant costs and questions.
Okay, thank you for that. So I guess the question is, right now, sitting here, right here today, do you expect you'd probably be up close to the $120,000 per month by December? I guess I'm wondering, staffing, or you're gonna just try to go as long as you can with the existing staff?
Exactly.
Okay.
Yeah. So the other question was the roughly $400,000 we budgeted for third-party engineering. So far, we haven't needed yet. That we think will probably still come up as the course of the year goes on. So, but I would say we can do a revised forecast based on labor at a lower number of FTEs if needed, but the 1.4 seems a little bit too high versus what we're running at today.
Okay. Yeah, could you do a reforecast on that? Thank you. Is that a supplement?
You want that as a late file or a supplement?
I think a supplement should be fine.
Is there an existing?
Huh?
Is there an existing?
Well, I'm just thinking in terms of, so wait a second. I'm looking at the compliance filing. So it's not an interrog, but the known and measurable filing, Exhibit 21, having that updated.
Okay.
But
sure.
And I'm thinking that would be a supplement.
Does that work for the company?
Is that doable, Mr. Bruno?
Yeah, there's a couple different exhibits, I guess, in the process. There's Exhibit 21, there's the CAE 12, and then there's also, when we did the most recent one, I think it was CAE 55, where we had the 4 months of the year-to-date actuals. we can easily update that one and take the 4 months and forecast that for the rest of the year if you want to use that exhibit, but whatever.
Yeah.
So just for the record, which exhibit will the supplement be filed on?
55, CA 55.
DAE 55.
Thank you.
You got it.
Thank you.
Thanks. And that's it for IES.
Okay, thank you.
My next questions are related to the RDM and CAE 62.
I have that. Yes.
Thank you. So in CA 62, the company stated the increase in rental revenue within 2024 is due to an increase in the number of rental agreements as compared to 2023. Generally, what are the rental agreements in which the company engages?
I don't have a complete listing of all the rental agreements, but
Just generally.
I think there's a number of different agreements that we may have just for rental property, or there's obviously the other line is pole attachments, which is separate and other things, but I don't have a complete list of all the rental agreements we have or the inventory.
Yeah, no, I'm just wondering sort of generally what is it? It's facilities that you own, no longer use, and now you rent them out. You used them at one point. What's the general story of it?
So I can give you one example. CLMP owns a facility where there are Yankee Gas employees that occupy a portion of that facility. So CLMP issues an intercompany charge to Yankee Gas.
Got it.
Yes.
Okay,
Correct.
so
That would fall on CLMP's books and records as rental revenue. And then on Yankee Gas's books, it would fall as rental expense.
Okay, thank you. I'm just another one that crossed my mind. Dutch Point, they're in your facility in Berlin, right? Are there any like that where it's a totally external provider? I'm not even sure if they would be that, or if you could speak to that or not.
So that one specifically is, the building is not owned by CLMP.
Got it.
Yes. So
Okay.
it's outside of the purview of CLMP's rental revenue.
Got it. Okay, thank you. And so the second question on this, why did the number of rental agreements increase in 2024?
I think generally those can change just year to year naturally. Again, I don't have a complete inventory for you as well. But there are also times that when the company goes through an analysis, as these rental revenues are billed out, there's an analysis done to evaluate from a rental standpoint, is that for a prospective period of billing? And typically under the accounting rules, if it is a prospective billing, you would have a prepaid rent and you would recognize that over the term of the agreement. So if you build it, if the customer asks for it to be all billed up front, you can have that recognized in a certain period and then deferred and recognized over a period of time. So there are also occasionally some true ups as well that can kind of flow through the activity where you may have had something that you thought was a lease over the next 12 months. And then when you review the actual bill and the invoice and the payment that comes through in the next month, it may be identified, oh, that should have been a prepaid. So there can be some movements, and you can kind of see that in the monthly activity as well, where there can be true ups as well. But I think generally to the rental agreement population, that can fluctuate over time.
Yeah, okay, thank you for that. The company stated the year-over-year increase in pole attachment revenue is primarily due to an increase in pole attachment rates and additional pole attachments in 2024 as compared to 2023. Why did the company have more pole attachments in 2024 versus 2023? Again, just generally, just the pattern, if you could speak to that.
Yeah, I don't have, again, any sort of listing, or I'm not involved.
Just increased activity. For pole attaching entities, as well as the rate changes due to changes in cost. Those are the two components driving that.
Okay, was there a reason for increased activity?
The market of entities who are attaching to our poles, I mean,
Okay.
We'd have to sort of look into that further, but that's generally what drives that. It's just increased numbers of attachments.
Okay.
And if I could just add, it's in cases where, like with 5G networking expansion in the state of Connecticut and New England in general, there's been an influx of like new attachers who come into the competitive market in the state of Connecticut. Clearly, they're going to want to attach their own wires onto our poles. So they come in. If you ever look at a pole and you start seeing more and more wires, that's the number of those 5G networking, like your Verizons, your AT&Ts, anyone who's coming in to really bring in more competition. You're going to get that additional attachment revenue from those pole attachers.
Thank you. I appreciate that. The reason I was asking about this, I think it went from about $2 million to $4 million. So like 100% jump, if I recall correctly, off the top of my head. And so I just wanted to understand a little bit better. So thank you for that. It's just a general trend across New England or Connecticut. More pole, yeah.
We have seen more pole attachment requests coming in at CLMP over the last few years, correct? So it would not surprise me that we do see the pole attachment revenue increasing. In addition to that, as Mr. Davis stated, there's the actual pole attachment rate itself and the annual revenues. Those are updated on an annual basis based on so you know the answer, based on the FERC Form 1 most recent information. And so that in and of itself, we have increased costs that are flowing through, which may also add to that. With the increased cost, the pole attachment revenue is based on the rental rate. And so it's likely that those came up subject to check if Pura requests.
Yeah, thank you. The company stated both the rental and pole attachment revenues had a one-time adjustment in April 2024 that caused the debit balances. Why did the company have this one-time adjustment in April 2024 for rentals and pole attachments?
Yeah, so I think that's getting back to what I was previously talking about. Rental agreements or pole attachment agreements, they can be over certain periods of time. And when the billing may originally go out in a given month, it may not be as clear on the invoice. When the company goes through its full control process to really evaluate all that, there can be times where there's activity that is either moved from a recognition standpoint to a prepaid or subsequently amortized, and it can kind of go both ways. So that's why you can see some of that activity month to month in between quarters, where there can be some true ups where an invoice has gone out, and by the month end close, it may not have been finalized into a prepaid asset. It could subsequently go to that. And that's why you're seeing some of that debit activity. Is just there's some adjustments to ensure that the accounting is appropriate, to ensure that prepaid activity is appropriately stated and then subsequently amortized over the recognition period.
Okay. So, all right. So in April, you basically had something of a cleanup on some of the contracts, making sure that they were accurately recorded.
Yeah, it's just to make sure that the billing and the revenues are recognized when they should be recognized.
Okay. Thank you.
Yep.
So a question about uncollectibles. I'm wondering about the recovery. Oh, sorry. I'm referring to CAE 67 and the recoveries. And I'm just kind of wondering about the process there. So after uncollectibles are, written off, what happens after that? Is it, do you engage a debt collector, sell your receivables? What do those recoveries sort of represent? Typically.
Are you looking for more of like how the numbers are flowing through the general ledger system, or are you looking more for the collection side, which would probably be Mr. Trainer?
The collection side. And to be specific, I think it was in CAE 67, but I'm wondering about non-hardship uncollectibles.
Yeah, so any accounts that end their service either voluntarily, they move out of state, move to another location, maybe the account's in somebody else's name, or get shut off for non-payment and don't end up restarting their service, or any commercial industrial customers. Once they reach around 60 days subject to check after their final bill, they would be sent to a collection agency. And they go through a process where the initial collection agency gets it, and if they're unsuccessful, After a period of time, it goes to another one, and then to another one, and then to the fourth and final collection agency up to the statute of limitations. So if it remains uncollectible, like not paid through that entire period of time, then after the statute of limitations, we do not try to collect anymore.
Okay, so the recoveries are basically just coming through collections agency, more common than anyone paying it after the fact.
Right, they go through, the customer can pay the collection agency, they can pay us. So either way, it comes in as a recovery like that.
Okay, thank you. That is it for me. Thank you.
Mr. Capozzi?
Thank you, Commissioner. Good morning, panel. I have a few questions about the company's procurement.
And we have a couple of witnesses approaching. Thank you.
Good morning. So I have first I have a few questions about the company's procurement policy or procurement manual. If you could turn to RSR 5, attachment 1. I don't have that one. I have an old one. Thank you, Kate. At first, I have just a few general questions about the company's procurement policy. So the policy requires that all purchases over $50,000 undergo a competitively bid process. Is that correct? But there's also a separate channel where purchases over 50,000 can bypass that competitive process by being processed as a sole source procurement. Is that correct?
That is correct.
Okay. And under the sole source procurements, there's a documentation that's required to justify the use of the sole source exception. Is that correct?
That is correct.
Okay. And reviewers under that process, so under sole source procurements, reviewers and approvers of those sole source procurement requests, they would rely on this documentation when considering whether to grant approval. Is that correct?
Yes, they may have additional questions and those would be added to that document, but yes, that's correct.
Okay. And is all that information incorporated into the company's procurement tool?
So there are two situations that might occur where a sole source would be applicable. In one instance, the DR would be created and the sole source justification is managed through the ERP system and it's specific to that one DR. In other instances, you can have situations where there are numerous records that we're trying to aggregate over a period of time. And in those cases, there may be a paper form that's used and that's managed within our sourcing and contracting system to support that contract.
Okay. When you, to the first scenario, you use the acronym DR. What does DR mean?
I apologize. Desktop requisition. It's a request coming from the business partner for a particular material or service.
And that goes through the procurement management tool? Or,
yes.
Okay. And then you also use an acronym ERP, I think it was. What was that?
Enterprise Resources Planning. So that's our system that we utilize to manage our procure to pay process, including the requisition of materials.
Okay. So you may have electronic and or hard copies of the justification for sole source?
That's correct.
Thank you. So if we could turn to RSR 5, attachment 1, page 7 of 13, please. Let me know when you're ready.
So that wasn't it. Thank you. We have it.
Thank you. So looking at section 7.5, this section outlines other exceptions to the competitive bidding process. And by other, I mean other than sole source exceptions. Is that correct?
That is correct.
Okay. So does the company's procurement policy require documentation of these exceptions to the competitive bidding at the time? Does it require documentation be made at the time the decisions were made about this?
So there isn't any formal documentation process that's been in place historically. That's something that is escalated and identified as well as being logged in the record that is applicable at that time. Based on some of the regulatory requests that we've received, have identified an opportunity to standardize that approach. So we've implemented a form that includes pertinent details, including the specific exception within the procurement manual. So that way we have better traceability and visibility into what the situation actually entails.
Okay, well, when was that form implemented?
That was implemented at the first quarter of this year.
Okay. Okay. So what information prior to that, what information did reviewers and approvers rely on to approve the procurements that are exempt from the competitive bidding process?
Sure. So the approvals wouldn't be driven by the exception. It would be driven based on the value of the PO or contract that's being approved. The information that they would be logging was previously directed to be appropriate to justify the decision that was being made and supported.
So, is, when you say, the review and approval is driven by the value of the contract, when you say that, do you mean the procurement tool has certain functionality built within it, which will identify which reviewers are required to make approval, or which personnel are required to make approval?
Yes, that's correct. Both our contracting system as well as our ERP system has the DOA functionality embedded within it to ensure that we have compliance, and we include the necessary approvers at the outset of the request and that we obtain those approvals adequately.
Okay. DOA meaning delegation of authority?
That's correct. I apologize.
Okay. So by default, one of the first requirements then is if any purchase order contract is over $50,000, that would require a competitive process, which has a certain set of reviewers or approvers.
The delegation of authority provided to our agents is not aligned to the $50,000 threshold. Depending on the level of the agent, they could have a greater threshold. Our most junior agents have $50,000, but sourcing agents, senior sourcing agents, and category leads all have delegation that is greater than that value.
I see. Okay. Do you know if the delegation of authority policy is in the record in this proceeding?
I know that we had discussed it. I'd have to review. And if it's not, we could take that as a late file.
Maybe I'll just request a late file, Commissioner. Company's delegation of authority policy.
Okay, late file number 5.
This may be in the record. May we have the opportunity to check during the lunch break?
Sure. Why don't you check during a lunch break and then we'll circle back if we need to create a late file.
Thank you.
Okay, cool.
Thank you. So I want to go back to what type of documentation is required for these exceptions under section 7.5. So are there documentation requirements in the policy under these exceptions under 7.5 justifying these exceptions?
So there's nothing in the policy that's required or that is explicitly identified to substantiate it. The expectation had previously been that the agents would log details associated with the purchase that align with an identified and documented exception within the policy. However, we have recognized an opportunity for improvement in this area, and that's why we've taken the action to kind of standardize a format for this information, just as a note and for additional clarity, similar to the sole source justification, where it may be in the ERP system and it may be in the sourcing and contracting system. We have similar functionality where a PO could be supported by an exception, meaning it's not supported by an overarching contract. And in those situations, we have a template for the log. So that way it's not just free form text to explain the scenario, but they have a pre-structured format to provide those details. What you've likely seen, and I think we had discussed when we were going through the audit, is the Word template, and that would still be applicable for situations where it's a contract that's being supported. So we're able to upload that detail into the internal contract documents.
Okay, thank you. So any procurement made is governed by, will require approvals governed by the delegation of authority policy. That's correct?
That is correct.
But any exception, okay. So I want to, so let's turn, I think you had mentioned some of these exception documentation. So I want to turn to RSR 8 attachment 2, which is an example of one of these. Let me know when you're ready.
I do see it.
Okay, thank you. So in this one, this form, I think you had mentioned this, but these forms were prepared prior to the audit. They were not prepared at the time the contract or purchase order was made, or prior to that.
That's correct.
Okay. Under section 2 here, where it says policy exception invoked, I see policy section 7.55. Are there any written records indicating that policy exception was invoked at the time?
I'd have to review and verify. That was a situation where the agent recognized that the value that would be driven by a competitive bid was so low that it wouldn't substantiate the competitive bid. We have reviewed that situation with the agent and used it as a learning opportunity, because in this situation, we've discussed and we feel it would be more appropriate, more adequately documented to be processed as a sole source exception.
Thank you. In general, when certain of these policy exceptions are invoked or have been invoked, when they have been invoked, does the company have records indicating those?
So in many cases, we have logs that are included on the PO. In some cases, those were communicated to the necessary approvers. And in this case, it required management approval based on the value associated with the record. And in those cases, it would more likely be that they had simply communicated it, but the best practice would be to log some detail.
Okay.
Again, moving forward, the expectation will be that they have that documented consistently in the PO or contract.
Okay. Is it fair to say for whenever these policy exceptions were invoked, there may or may not be a log from the time indicating which specific exception?
That is correct.
Okay. When I see here under reference documents subsection, I see not applicable. What does that mean here?
So that means that there's no documentation that's supporting the exception. In some cases, there can be additional detail that might be in the form of an email or a narrative to explain the scenario. The area where that's most common is if there's a strategic decision made by an executive leader within the company. We would typically file that email as record in support of the justification.
So if there's no email in this exception documentation, then there's no email for that.
It means that we weren't able to produce it after the fact.
Okay. But NA can also mean that there were no logs, no relevant logs indicating justification or support.
I don't believe that we were utilizing that section to identify the logs. We had had discussions with the agents where this hadn't previously been a requirement. There could be logs associated.
Okay. Okay, and under situation narrative, so if there were no logs, and we can use a specific one or just talk generally, situation narrative, if there were no written records or reference documents available, how did the company determine, what was the process you used to determine the narrative behind these procurements?
So that was primarily derived from discussions with the agents. Part of the decision to implement the improved process was because we do have some, a large number of our employees who are coming upon retirement, which makes documentation more core and critical. It's also just generally an opportunity for improvement. So the majority of the situational narratives were derived from conversations with employees at Eversource who were close to the original purchase.
Okay, thank you. So this is still RSR 8 attachment 2. I see, I want to ask specifically about this procurement. So I see in here mention of a 5-year master agreement with Stoneham Ford. It's in the first paragraph of the situation narrative. My question is the master agreement a contract? Is it considered a contract by the company?
Yes.
Okay. Does the agreement have some value associated with it? Dollar value?
It generally wouldn't have a dollar value. I'd have to look into the system for master agreements. There may be a sub-agreement that was created, but I don't believe that master agreement would.
Okay. Do you know if that master agreement underwent a competitive RFP?
The master agreement with Stoneham Ford did not.
Okay. Can we please turn to RSR 8 attachment 11?
I have it up.
Thank you. So under approval obtained, so under section 2, exception explanation, and then I see a subsection approval obtained. I see not applicable. What does not applicable mean here?
Apologize. That just means that there wasn't an approval granted by any employee other than the agent who is, submitting the document.
Okay. Okay, and under situation narrative, I see this contract was created as a simplified acquisition. Can you explain what a simplified acquisition is?
So a simplified acquisition is a situation where we do not have a competitive bid and it is not a sole source.
Is the simplified acquisition included in the company's procurement manual?
I, I don't believe that it is. I think I would have to verify that though.
Okay. What are the procedures involved in a simplified acquisition? How does it differ from a competitive RFP or sole source?
So it's really related to the documentation that is necessary to support that situation. A simplified acquisition would require, it would not require that additional supporting documents.
Okay. I think my last question on this exhibit is I see the contract purchase date up under section 1. It says contract purchase date of February 13, 2020. And if I cross-reference that with the listing of the sample procurements, which was in RSR 7, attachment 2. Let me know when you have that.
I have that.
Okay. I believe this purchase was 3 up from the bottom. So the William Scottman purchase order 13099-132. And I see the start date of January 26, 2023. So can you explain the difference between that purchase order date of January 26, 2023 and the contract purchase date of February 13th, 2020 provided in the exception form?
I believe I have an explanation. I just want to verify the detail. If you can give me just a moment. So in this situation, there was a contract in place with that vendor. The value of the PO or the date associated with the PO is the date that is identified in attachment 2. This documentation was actually in support of both the contract and the PO. The initiation date of the contract associated was actually the February 13th of 2020 date.
Okay, thank you. Do you know if that original contract was competitively bid?
It was not.
Actually, I have one more question on this. Looking at the policy exception invoked subsection under section 2, I see a reference to a prior procurement manual. Is that correct?
I just want to make sure I understand where you're looking on
Sorry.
attachment 2.
I'm sorry, this is back to RSR 8, attachment 11.
All right.
Apologies.
I do see that.
Okay, under section 2, policy and exception invoked subsection, I see a reference to a prior version of the procurement manual. Is that correct? Revision 18?
That's correct.
Okay. This exception looks like a sole source exception. Is that prior manual did that have sole source under section 7.5 in that version of the manual?
There
Or
was
is something else going on?
You can give me a moment just to make sure I understand the documentation before I respond.
Bless you.
I'd like to review with the agent and verify, but I believe there may be an issue with the documentation in terms of the section referenced.
Okay. Do you know do you know whether prior versions of the procurement manual had, well, I'll just strike that question. Okay. So I think earlier you had mentioned, when you had developed when you had developed the exception documentation template, you had mentioned back in Q1 of this year, you had mentioned one of the reasons for doing so was regulatory requests help incentivize its creation. Is that correct?
That was what had driven the recognition of the need for it. A big part of it was, the recognition of that need. Another aspect was making sure that we were pulling out the details that, should be present and documented with each record.
Okay. When you say regulatory requests, are you referring to the audit requests being the regulatory requests, or was it some other regulatory requests that incentivize that?
So there were regulatory requests prior to the audit where we had gone through and used a similar format. So we had already established and created that form. And, we are in the process of rolling it out across the teams.
What was the regulatory, what was the regulatory request in that specific instance?
I believe that we started utilizing the form as part of a mass grid mod filing. And then we've also utilized it in since regulatory requests that we've received.
Okay. Okay. Which regulatory body made was behind that request?
I believe it started with the DPU, and then we have utilized it on regulatory requests since. The form has evolved over time, and we're now at a point where we feel like it is in a form that we can roll out.
When you say the DPU, do you mean Connecticut PURA or Mass DPU or?
Mass Department of Utility.
Okay. I think that's all the questions I have. I just have one late file request, I believe, which is I would like any logs made available in the, you recall our discussion about the logs available for the different exceptions. Any logs available for a certain, I'm going to identify in RSR 8 specific attachments. RSR 8 attachment 2, attachment 5, attachment 7, attachment 10, and attachment 11. I can repeat those if necessary, but any logs available for those exceptions.
So just to make sure I have those correctly, you're looking for logs available within the ERP system. And again, I just want to verify those would typically only be available for POs. If it is a contract, we can search for any relevant documentation that hasn't already been provided, but those would be applicable to attachments 2, 5, 7, 10, and 11.
That's correct. So I will amend it to any logs or other available documentation.
Thank you. I believe that's late file exhibit 6.
That's right. I believe those are all the questions I have. Thank you very much, panel.
Thank you.
Thank you. Anything further from authority staff? No, all set. Okay, let's take our lunch break. When we resume at 12:45, it will be with Cross from the Office of Consumer Counsel, please. Good after 5:01:03. Are there any administrative matters before we resume with Cross?
Yes, briefly. Thank you, Chairman. To follow up on Mr. Capozzi's cross-examination before lunch, the delegation of authority is not in the record, so the company would be happy to provide that as late filed Exhibit 7.
Okay, I may have missed this, but I think we had marked it as 5 already.
Then we would be pleased to provide it as late filed Exhibit 5.
Okay. All right, thank you. Very good. Anything further?
Nothing, thank you.
Thank you. Okay, then let's resume with Cross by the OCC, please.
Good afternoon, Albert Zablowski for OCC. The company has a late file on the PPAs, or was it a supplement to C55, I believe? Where it's supposed to update the information for the most current data, I believe. Can the company also provide a recommendation as to what rate change to NBFMCC the company would recommend if the rate was to change using that latest available information? Is that possible?
Yes, we can provide that. Thank you.
Thank you.
I apologize. I missed that. Was that a new late file exhibit request?
No, I think there's an existing late file, or maybe it was CAE 55 supplement or update.
Okay, and so you're just asking them to add that to the,
Yes, just add the recommendation along with the newest data.
thank you.
Yeah, so apologies. I have a supplement to RRU 10.
Okay.
Is that the one that you're referring to, that you'd like us to also provide a recommended rate change in addition?
It doesn't really matter to me or where you do it, as long as using that updated through May, I believe, PPA data with revenues and expenses, right? If the company could just provide a recommendation to the NBFMCC rate based on those numbers.
Understood. And just to clarify, it's for just the actual activity,
Yep,
correct, recorded in both April and May. That's not yet. Okay, perfect. Yes, not the forecast period.
Thank you. We've asked for this one in the prior year's RAM as well, but let me restate it. Can the company provide a listing of account receivable data for financial hardship and medically protected customer accounts with balance breakdown between 0 to 2,000, 2 to 5,000, 5 to 10,000, and above $10,000? This is essentially the same question that we asked in late file 4 of the prior year's RAM. With the one caveat being, could you also provide amount totals per category and the sum total balances as well, so that they just tie to the whole, to the total amount?
I think I got that. But it's basically the same one we did last year.
Yes.
Yeah.
It's just with subtotals, so just because they're ranges, so it's a little hard to calculate the total from that.
Sure, we can do that.
I'll mark that as late file exhibit 7.
And just one clarifying question, do you have the response from last year?
I do.
Number?
it's late file 4. Is that what you're asking?
Yes,
Yes.
thank you. Sorry, what late file number is that in this proceeding?
7.
Thank you.
And moving on to Rex, following up on Mr. Norton's cross on 1/4 of Rex not being booked, I guess. I think I heard the company state that it wasn't booked and therefore not included in the known and measurable filing that was due January 15th. Is that correct?
That is correct, yes. By the time the company prepares for the known and measurable filing, it typically takes us several weeks in preparation for that. So when we made that filing, the information had not yet been available to supplement the record. I shouldn't say supplement the record, excuse me, to populate the record in time for the filing, excuse me.
Thank you. And are there other dates the company provides filings in this RAM docket that it could do so in?
Could you repeat the question? I'm sorry.
Sure. And does the company file any other exhibits at different times in the future in this docket where it basically could have provided that information as a known and measurable adjustment?
If I agree with your line of questioning, I think what I would say is there's certain circumstances where, depending on the information and when it's regularly received and the company records it on the books and records, as Ms. Purbeck indicated, it all depends on when that information is known. And so that's when it's recorded on the company's books and records. Typically, the way our department views that type of information is it's ebb and flow depending on, again, when that information and those pricing amounts and the actual costs and we'll say net revenues are known. That's when it's included in the filing. Could we have updated the filing later to consider that? We could have, but we treat certain areas as ebb and flow within the company's books and records. Otherwise, we could be looking at every single line item and looking at the activity. So there's a point in time where the company has to perform a certain cutoff. And for us, that's truly the known and measurable filing as of January 15. Anything significant or material after that, the company is open to presenting it to PURA and, requesting a supplemental filing to the known and measurable.
Didn't the company update the expected PPA costs after the known and measurable filing in this docket?
And that is a perfect example of an item that we know is extremely volatile and material to customer rates. So in that scenario, we identified it in our known and measurable filing as a specific other item within our pre-filed testimony where we indicated that we did not have enough information at the time of the known and measurable filing to include a known amount. However, the company requested that it be allowed to continue to update the record for that particular known and measurable. So we do have certain circumstances. That's a great example, Mr. Zabowski, where we know that that one has to be updated because the known and measurable is just too early to determine that amount. And we know it's going to be volatile enough to update the record for.
Thank you. So just continuing with that, so would the Rex be one of those categories that could be earmarked for updating in the future? Or is there any sort of, I guess, criteria that you would use? Would that be like a dollar value, a dollar amount, or any other specific sort of criteria for, providing that down the line, I guess, for any item?
May I have a moment to concur with my team? So the known and measurable filing is performed on January 15th. Any circumstances that the company is aware of that is known but not yet measurable at the time of preparation is included in that filing. If there is a change to the known and measurable definition that key stakeholders or Pure would like to revise, we would expect that conversation to happen in docket number 2024-1205 that's currently open.
I appreciate that. Thank you. Ready. And we move to the March 3rd, 2025 filing. I think this is Exhibit D9, Renewable Portfolio Standard Self-Supply True-Up.
We have it, if you wouldn't mind asking the question, and then we may have to just call up another witness.
Okay.
Thank you.
And my question is, I hope simple. It's just, if you could explain how the estimate here is arrived at. I guess I see that the actuals were available in June of last year, but just curious about how the estimate itself is arrived at, forecasted.
Would we be able to take a late file for that, if possible?
Yes.
Thank you.
absolutely. So,
Mr. Zabowski, if you could restate that, it will become late file exhibit 8.
so I think this is, yeah, late file 8, renewable exhibit D9, renewable portfolio standard, is estimate calculation or how it's arrived at. That could be explained. Thank you.
Thank you.
Could we please move on to Exhibit F and BFMCC? And this is page 4, so tab page 4, 2024 forecast.
We're there.
We got
Okay. And just for the annual revenues, historically speaking, how close has the company forecast have been to actuals? Just generally, if you could.
Well, I think you have to keep in mind that this calculation on page 4 is done at a point in time. It is done on March, in this case, I think March 3rd, with the rates that were in effect at March 3rd. And those rates are frequently changed afterwards. So there would be no relationship to the actuals for a given year based on the changes that have occurred after the date of this filing.
And the rates are just one part of this calculation, correct? So there's also the kilowatt hours, correct?
That's correct.
Okay, and those I know are highly variable depending to weather and things of that nature.
Yes.
But does the company keep track of how accurate these are, I guess?
We do have a we do have a forecasting team that forecasts sales. And they do, analysis of what future sales are going to be based on historic sales plus whatever other economic factors impact sales.
Does the company keep track of, obviously it's, going forward forecasts and with every RAM, I guess, for on an annual basis, I guess, or monthly basis, and then go back and check how those obviously fared actuals?
We do not do that within our department
Okay.
because we are recovering costs. So we're highly focused on the costs.
Just to add what Mr. Shelnut said, as a reminder, we include a forecast within our rate reconciliation mechanism, and then the whole year passes us, and then we get to the end of the year. We ensure that our rate reconciliation mechanism the following year, encompasses any forecast actual sales changes throughout the calendar year. So in this example, we are presenting a 2025 forecast. When we file next year, that actual that flows through, which impacts the revenues recovered, of course, that will flow through naturally through the rate reconciliation mechanism. So we are only going to be including the actual sales that occurred.
Sure. I guess, in essence, wanted to check the accuracy of that over let's say, the last couple of years, because as we've said, rates are just part of that calculation. So if sales are down because the forecast was, let's say, less than optimal in a given year, that will also impact the revenues, and henceforth we would have an under recovery to some extent, correct?
Or an over recovery. Go either way.
And to further answer the question, there is analysis performed. It's just not performed within our department, the Revenue Requirements Organization. But as Mr. Shelnutt's indicated, we do have a load forecasting team that does look at sales trends, analyzes it from a historical to actual to forecasted perspective. We just can't speak to the amount and level of detail performed, unfortunately, today.
Okay. Thank you. I'll move on. Same exhibit, page 5, tab page 5. I guess with conjunction with RRU-9. There are contracts for differences costs. And as we can see from this exhibit and from RU9, one of these has ended, and I believe that's Waterside. In RU9 has a listing of dates, and I believe, is that a list of dates where these contracts end, or are they going to roll off the RAM? I guess that's the question.
Just 1 second, I'm pulling up the.
Sure.
Correct, the Waterside contract expired on May 31st, 2024.
Okay, so it's RRU9 attachment 1 that has a dates of sunset date for these programs, for these contracts. And so I guess I see another one in here that's ending in 2025 and one that's ending in 2026. I guess my question is, then those would roll off the RAM the following year of that date. Is that correct?
That is correct. Yes, it would fall off where in the calendar year that those contracts do expire. That is at the point in time that it would be reflected in the RAM. However, I will add that the company works closely with Ms. Purbeck's team, and for any contracts that we expect to roll off, the company ensures that it is captured within a known and measurable filing exhibit.
Thank you. And
That exhibit in this year's RAM is Exhibit 17 to the known and measurable filing.
and I don't know if you can speak to this, but is there any plans to extend any of these, or are those sunset dates pretty certain as of right now?
There are no plans that I'm aware of to extend them at this time.
Thank you.
It's, it would need to be approved by Pura. If an extension were requested, it would need to go through the Pura process and be approved accordingly, in conjunction with DEEP.
Thank you. Same exhibit, page 13, EIA, Energy Independence Act. I did say page 13, right? Correct? Because somehow I heard 19 in my head.
Yes, we are there.
Yes, 13.
Thank you. Um, Okay. Line 19 has something called Eversource incentive. And I see three values here for the months of March, April, and December. Can you explain what those are and why are they in those particular months, and what is that a function of?
Yes, absolutely. So, thank you. The incentives are a one-time payment to Eversource for connecting a gas generator that is enrolled in the gas rebate program. Once they begin generating electricity via a natural gas generator of various types, it consists of a $50 per kilowatt award of generation. And incentive payments made in year 2024 were related to three specific projects. Those are the University of Hartford at 1,840 kilowatts, Connecticut Manchester Community College at 250 kilowatts, and East Hartford Board of Education at 250 kilowatts.
Great.
And just to support Mr. Roy's record testimony, there's Exhibit F, page 15, where it does list the customer / developer, as Mr. Roy indicated, disclosed there in our January, sorry, our Exhibit F, page 15.
Thank you. I was going there next, but on the same exhibit, can we just go to page 14 really quick? So next tab over. Sounds probably simple. This sheet heading is actual gas rebates. When I subtotal CNG, SCG, and Yankee, I get 2.25 million for CNG, 80,000 for SCG, and 22 million for Yankee. And this is just a function of service area or geography? Or were the projects? Yep.
It's essentially, so Yankee is going to be all of the Eversource participants in the program. The CNG is Connecticut Natural Gas as participants in the program, and Southern Connecticut Gas as participants in the program. So we administer the payments of these rebates for all three of those companies.
And to your point, Mr. Zabowski, it is dependent on where these developers actually installed their generation facility. If it's located in the Yankee Gas service territory, then it would be a Yankee Gas bill, and then the same with CNG and SCG.
Makes sense. Thank you. So Excel line 9 on that same tab, second table, gas utility dash customer dash Connecticut Light and Power. It's one of the few customers here listed with a value of 0. And does that signify anything? Same for others, such as Manchester Community College. United Technologies, YMCA, Meriden, et cetera? Or are these simply carryovers from a table from a year prior?
Those particular instances are carryovers from prior years. They're no longer generating and no longer participating in the program.
Thank you. Okay, my next question is going to be about EV program costs. I have a question about the historical costs exhibit CC, as well as the non-measurable adjustment from the last year's final decision, the last docket.
Which exhibit do you want to do first?
From the exhibit CC, all I wanted is basically just to reference it to say that I'm seeing a 2024 EV program actuals of about $17.5 million.
Correct.
Okay. And then looking back at the September 2024 decision and the updated NBFMCC exhibit filed in August 22nd of 2024, I see a known and measurable adjustment of 24.331 million for the period of June 24 through December 2024. Is that correct?
Correct.
Okay. So that's a difference of about 6.8 million or so, subject to check, would you say?
Yeah, if I could help out a little bit, I think there were, and Marissa and others can help out as well, but essentially there was the EV amortization portion was covered cost from roughly 22 to 2024 of May, and that went through a 20-month amortization process. And then starting in June of 2024, that's after that other period. So June 2024 to December is the next period.
Okay. So if I add the. Okay.
Can I just ask what exhibit you're looking at right now again?
Sure. So if I look at the updated NBFMCC exhibit filed in August 22nd of 2024 by the company, that has a known and measurable adjustment of 24.331 million for June 2024 through December 2024 costs. What I'm trying to square is what makes up that amount if the actuals for 2024 were 17.5. I guess there is going to be a difference. I didn't expect the difference to be that great.
I think I know, and please help me understand. I think I understand where you're headed. Please confirm. Are you trying to understand the difference between what was included in our filing last year as a known and measurable for the remaining term of the EV program for the period June 1 through December 31, which was clearly a known and measurable because not the full year had passed when we filed that for the September 1 rate filing, and then determine what actually occurred? Is that
Yes.
the purpose? Okay, so, and that's why we conferred for just a minute. I thought that's where you were headed. Now that ebb and flow is happening right within our rate reconciliation mechanism, right? So the rates were set September 1. That revenue stream is going to come in through our rate reconciliation mechanism on your line 1. And then below that, as Mr. Bruno's team continues with his actual EV program costs, below that, you're going to have your actual EV program costs flowing through. And that's what our team picks up in the general ledger system. Ultimately, at the end of the year, you're going to have a fallout of over under recovery. So that is what's flowing through the rate reconciliation mechanism this year. Now, in the known and measurable, what occurs is we have to look at what actually occurred in 2024 and then compare that to what Mr. Bruno and his team give us in terms of what is the expectation for the 2025 rate setting process and what will occur in 2025 in terms of program costs in calendar year 2025. And then that's where we set the new known and measurable. Now, because we compare it to, actual, obviously, we're comparing it to a lower amount. However, the over under recovery that comes through the rate reconciliation will pick up anything that wasn't actually incurred. Does that help answer your question or where you were headed?
It does to some
Okay.
extent. Thank you. Let's stay on EV costs. Could we go to Exhibit F22? This is CT Electric Vehicle Charging Program 2024 actual costs.
I have it.
Okay. Second. Line 15. 1 second. Just 1 second. Okay, yep. Line 15, column I. This is managed charging residential for July 2024. And could you explain why that amount is negative?
Is it the line called multi-unit dwelling, level 2? Or is it the line,
No, line 15.
the $17,000 credit?
Yes, 17 and a half, yep.
Yeah, that I can follow up. Listen to
It's that has to do with the charges, so I'll have to see if there's a credit.
Yeah. We'll have to do that as a late file, that one.
Okay, I have more questions on this exhibit, so maybe we can hold off on the late file until I'm done. Or would you?
Sure. So you want to give me the late file description at the end of your questions?
Yes.
Yes,
please.
we can do that.
Just because if we look at line 26, column K, this is education outreach, including fleet engagement. This amount is also negative. So column K, line 26. That's
Yeah, that's, we'll do that in a late file as well, but I believe that's a reclass where a charge went to this particular program in the prior month. We had to reclass it because the education vendor would have supported multiple programs. So we would just have done a reclass to move it out of the EV program, to the appropriate program. But I'll confirm that in a late file along with the other question.
okay. And yes, those are the only questions probably pertaining to a late file. So this would be explain negative amounts in exhibit F22.
Okay.
And I'm just
And that's late file exhibit 9.
yes. Thank you. And that is it for my cross. I'm turning it over to Attorney Wheel. Thank you.
Good afternoon, Tom Wheeler for the Office of Consumer Counsel. I'm going to start with I have some questions about the NCQF, kind of following up on some questions I had the last time around, and about net metering generally. So I don't know if I assume we need a panel shuffle. Ready? Okay. First wanted to confirm my understanding of the questions I asked before. And the nature of my question is just sort of understanding what components of specifically net metering programs are kind of going into the NCQF. And that's the non-contract qualifying facilities portion of line item within the NBF MCC. It's my understanding that what goes into the NCQF is like any credit for production of behind the meter facilities that exceeds usage. Is that correct?
Close. So at kind of the most basic level, any credit that's provided on the bill, whether through legacy net metering or the RRES or NRES programs, is going to be reflected within the NCQF. That includes a monetary on-bill credit for net excess generation within a billing period, or the value of net excess kilowatt hours that are banked under the legacy net metering program. It also includes it also includes the value of excess generation within a billing cycle that offsets consumption within that billing cycle.
Okay. Thank you. So it's not. Sure.
Sorry about that. Also, keep in mind, we have, I'll call them different vintages of net metering. So what Mr. Rice just described would be those more legacy older structures where you carry the kilowatt hours and ultimately apply them. So I think the monetary amounts are when those kilowatt hour either banked or in the month kilowatt hour energy credits are actually applied and are monetized in that month. But over the course of a year, one way or the other, these amounts end up monetized and ultimately part of power purchase expense. Contrast that with kind of pre-NRES, RRES, sort of a second group of net metering where we simply pay out a dollar amount each month effectively, and that becomes a power purchase expense as well. And then we have the NRES, RRES, which is the more current, recent version.
Okay. Thank you. Because I guess the root of my question was just to confirm that there isn't any amount in decoupling or in any reconciliation of any individual line item. So for instance, like if you'll entertain a hypothetical, if I am an RRES customer and I use 700 kilowatt hours in a month, but then I produce 600 kilowatt hours in a month, the bill I pay is driven by 100 kilowatt hours ultimately, correct?
This is where it gets a little detailed. We will, to the extent we actually, prior to any on-bill netting, if there's behind the meter displaced kilowatt hours that physically happen during a month, those never become part of billed kilowatt hours, and talking about distribution rates in the context of revenue decoupling. So that's effectively the displaced sales from whatever production. So if it's 600 kilowatt hours that are produced and you're saying they draw 700 during that same month, there might be a netting of those amounts. Remember, I mentioned 3 different types of net metering, but generally they may not always be producing those 600 kilowatt hours and using those behind the meter not in the middle of the night, solar. Although we do have net metering that's not solar. But to the extent there's production that's greater than, as Mr. Rice said, greater than their usage at any point in time, that is captured by our meter as an export kilowatt hours. So some share of that 600 kilowatt hours that's produced may not be displacing power behind the meter. So what we're going to do is we're going to recognize any metered kilowatt hours that come in during the course of a month from the grid that's not met by self-supply by the customer. And we're going to recognize that amount as the bill distribution revenue prior to any on-bill netting, et cetera. So the first half of the questioning here dealt with the amount that's delivered out to the grid, and that's monetized and, becomes a power purchase expense. The behind the meter is actually what's displaced distribution, sales, and revenue. And they're two separate things. They're distinctly separate. So revenue decoupling is looking at the amount of billed revenue prior to a netting mechanism that might be applied. And so it's definitely purely, there's a bright line there. Physically what happens, the meter kind of creates the bright line. And then the accounting of that is done in a way so that we recognize kilowatt hours delivered from the grid to the customer. That's our distribution revenue. We recognize that. And then net metering has its own separate process after that, but they are distinct.
Okay. I think I understand. I guess what I'm driving at it, like conceptually is, like, imagine that Eversource has one customer and a distribution revenue requirement of $100. In a year, it has to collect $100 from that customer. Let's call it $1,200. So every month it has to collect $100 from that customer. If that customer is pulling in, and you'd set rates presumably you set a volumetric rate to collect $100 a month. But if that customer adds solar, then ultimately the revenue for distribution coming from that customer is not going to equal $1,200 at the end of the year, correct?
Yes, correct.
So that revenue, with that gap, so if the company only collects $600 from that customer in the year, would that $600 show up in decoupling for that one customer?
It would. And so we'd bill that one customer the 600 kilowatt hours or the dollars over the subsequent year.
Right. Yes. So similarly,
under recovery. Yeah.
Yep. Okay. I understand now.
And it's an extreme example, but it certainly makes a point. Yeah.
Yeah. Yeah. Well, and I guess the follow-up question is, given that Eversource has more than one customer and multiple vintages of net metering, I take your previous response to mean that there isn't like an accounting that in the calculation of an under or over collection, there isn't like a direct accounting for what potential sales difference is driven by net metering. Is that correct?
We do a full total amount of, there's no netting here. We don't start with the netting. We have the grand total amount of actually billed kilowatt hours, and separately the entire amount of exports and under the various net metering structures, the credits or payments that go with those, so power purchase expense. But there is that separate accounting that allows us to track what we designed into rates and what the target revenues were expected to be under a certain billed sales assumption. And the actual revenues that come in that are the result of what happens each month for each customer added up over the course of the year. So that's the actual verse, and we compare it to the target. It's really that simple at the highest level.
Yeah. So I guess another way to ask the question I'm trying to drive at is that from the perspective of the company, the example I just like the extent to which the sales target doesn't match the actuals because of net metering is it viewed the same as just sales, not like a customer not using as much as expected in the sales target? Is that?
There's no explicit customer specific recognition.
Okay.
Now, in the recovery and the revenue decoupling mechanism, we had an earlier discussion about the forecast sales that go into any one of the RAM mechanisms that may go into those. So that's going to recognize what we expect the sales to be in the future period, and that will set the unit rate that over which we expect to collect that for that coming year.
Understood. And that sales forecast, presumably, there was an earlier discussion about the level of complexity that goes into the sales forecast and that there's a team that does it, but that presumably has some level of the expected impact of net metering on ultimate sales is built into that, presumably.
Yeah, my understanding is there's some level of that reflected in that forecast sales that we use for rate setting purposes.
Okay. Thank you. My last question is, does it make a difference with respect to sort of where or if costs show up? Does it make a difference if energy is being produced at the same time as it's being used? So if like if a customer is simultaneously at the same time use in an hour using 1 kilowatt hour of energy from the grid and also producing 1 kilowatt hour of energy, does that have any impact on sort of the resulting impact to the NCQF or any other part of the RAM?
Yeah, yes. So I'll try to stick with maybe our hypothetical examples because I think they're helpful. So say if you have a hypothetical customer that uses 600 kilowatt hours in a month, and it uses half of that at night. They have solar. So they use 300 kilowatt hours at night when the sun isn't shining. That will be recorded as 300 kilowatt hours of usage. All right. And then during daylight hours, say that they also use 300 kilowatt hours, but they produce 400 kilowatt hours. Their usage will be zero, and they will have a credit for excess generation of 100 kilowatt hours. We're going to assume they're not on a time of use rate. That 100 kilowatt hours is going to offset, a portion of the 300 kilowatt hours that they use during evening hours over the course of the month.
Okay. Thank you. Understood. My next question, I'm not even sure if there needs to be a panel change. It doesn't have anything to do with the NCQF or net metering. It's a question about the Renewable Connections Program that doesn't exist anymore. United Illuminating has like 4 active projects that were built under that program. I was just asking to confirm whether Eversource, I didn't see any like line item in the NBFMCC that's attributable to that program, and my like general research suggests that Eversource never built a program under that, a project under that program, but I just wanted to confirm that.
I don't remember Eversource or CLMP doing businesses, the company having that. But it dawns on me that I recall something that UI did have with that name. But I don't
Okay.
recall that being a program that we offered. And certainly we would have accounted for it and it would show up as a line item in the detail.
Like, I think off the top of my head, I think UI has like a fuel cell in Woodbridge that was built according to that program, but I'm talking like a decade or so ago. So it's still,
That would make sense, especially at that time. That might have been one of their sort of developing or pilot programs at the time.
Okay.
But I don't know for sure.
Okay. Thank you. Yeah, so my question was just whether there was something in the Eversource filing that was labeled differently, but it sounds like I'm not missing something that was built under that program, probably. Okay.
Not to my knowledge.
Thank you. My next question is about OCC 24, the supplemental response, which pertains to internal O&M costs. And my questions are going to pertain to the program internal O&M costs that are identified in there. So LREC, ZREC, SHREC, SCEF, storage, IES, and
mix
RRES and NRES.
We're set.
Okay. So just for background, we had originally asked for there's a long history behind this particular response. We issued OCC 5 originally asking for an internal O&M costs. Then we issued OCC 24 asking for a breakdown of those costs. And then we asked about that response at the first hearing and asked for a supplement to that breakdown, which is this response. And I understand this response to generally be referring to some of the, well, at least with respect to the LREC, ZREC, SHREC, SCEF, and RRES and NRES, it's pointing us to Exhibit 1 in the known and measurable filing. Is that correct? Yeah.
Yep, understood.
Okay. And then to kind of follow the maze, exhibit 1 is the testimony, and then I think the reference to the specific reference in this interrogatory supplement to exhibit 1 is actually pointing to exhibit 12, which is referenced in the testimony. Am I following the trail correctly?
We'd have to follow the trail 1 second.
Okay.
Turn your wheel.
$32.
32.
Okay. Perfect. I think we've completed our trail.
Okay. And I should have, I think my question was starting with, I understood this, the reference to the testimony was suggesting that the testimony, I think, in various places points to the known and measurable exhibits that show the breakdowns of costs for these programs. Is that correct?
That's correct. And the pre-filed testimony also, provides a narrative to attempt to, explain how the programs are run and how that follows through the costs that are incurred.
Okay. Thank you. So exhibit 12 from the known and measurable filing in January, is that the best place to find the derivation supporting the RRES administrative costs that are provided in response to OCC 5?
Yes, it is.
Okay.
That's, again, exhibit 12 is specific to RS.
Yep. Okay. So I'm looking at that. I just had a couple of questions about that exhibit. Do you know why the monthly labor costs go from like $57,000, about $58,000 in January 2025, and that they increase all the way up to $121,283 by the end of December? Like, do you know what's driving that upward trajectory in the labor line item?
Yes, I think it's the addition of staff members. I know in particularly, we had one staff member that was supporting the program as a contractor. Bid for and was hired into a full-time position that was created to support the program.
Okay.
So we had a conversion of kind of outside services expense to internal labor.
But I noticed that like from July to August, and this is a prospective forecast of what the total labor is going to be for this program, like in 2025.
Mhm.
I just noticed that there's a significant jump from July to August, but then it kind of goes back down in September. Do you know generally what's driving the variability from month to month?
A number of things can drive the variability, and we'd be, of course, happy to kind of dig into it and provide, itemized calculations for each month. But just for example, Eversource payroll runs every 2 weeks. So we'll occasionally have a month in which 3 payroll cycles are included, and that'll impact variation. You can also have employee vacations will impact variability. So again, there are a number of things that can lead to variability. I can't say exactly what is happening each and every month in the exhibit, but
Sure.
we could certainly do so if provided the opportunity to go back and examine.
I guess my question is just, I assume part of like the calculation of these numbers is using an assumption of time, right? Like that it's applying at a certain number of hours, like internal labor hours per month.
So so for labor costs, we didn't apply a known and measurable adjustment to labor. So the values that are in Exhibit 12 really reflect prior year actuals.
Okay. So is that incremental employee then like something that happened in the prior year or something that's expected to happen in the coming year?
That's a good question. It happened in the prior year.
Okay.
It happened in 2024.
Okay. Thank you. Can you generally describe like what the services performed by the labor, like the internal, like what are these employees doing for the RRES program?
Of course. The biggest thing to start with is application review. Eversource gets anywhere from 300 to 400 RS applications a month, each of which is individually reviewed. And each of which has, several components of documentation that are reviewed, including the application, customer disclosure form. And there's a number of eligibility criteria that are checked for system sizing and other factors. Staff are also involved in supporting a high number of customer inquiries. We have dedicated phone lines and an inbox that customers can submit RS-related questions to. And we endeavor to turn those around in a prompt timeframe. And then we also have staff that are working on program development activities. In the past year, we've had a lot of work involved in ramping up the multifamily affordable housing elements of the RS program, which have required kind of more support with project participants as well as coordination with other departments.
Okay. Thank you. Do you know if generally the same staff members, I'm not asking about particular names, but are the same staff members also working on like NRES or LREC, ZREC, or there are separate staff members for each of those program administrative?
So there's separate teams for Eversource that support the RS program as opposed to the NRES program. Our organization is really divided between residential and commercial. So the RS team is very much focused on RS, but the staff that work on the NRES program also provide support to, supporting the LREC ZREC contracts that we maintain, as well as the SCEF program.
Okay. Back to the exhibit, what is the contract staff line item? That was $6,000 a month every month last year.
Yeah, again, so particularly with RS, because so much of the staffing requirements are driven by application review, which can fluctuate. We pretty much are always supplementing the team with contract staff to be responsive to those demands. So generally, more recently, we've had one contract staff, but we've had periods where we've had more, and we could have periods where we have less.
So is that like I don't know if this is like an offensive word or anything, but is that like a temp, like a staff member who's like hired through an agency? Is that?
Yeah, correct. Yeah.
Okay.
And it's, I mean, we just recognize that a lot of things can happen that would impact the company's requirements for the RS program, not least of which is a decline in application volume. So our staffing strategy reflects, preserving a level of flexibility.
Okay. I was going to ask about the distinction between contract staff and outside services, but is the distinction that outside services is like an outside vendor as opposed to a contracted staff member who's working in-house?
Correct.
Okay. And what are those outside vendors doing for the RS program?
The things that I discussed previously, in some respects, they do much of the same work that other staff members do. It's weighted more towards application review. We can train a person up on the process to review applications, and they can contribute to the team's effort in making sure that we turn those application reviews around. But they can also help out in other areas.
Okay. I noticed, by the way, I should have asked, there's no known and measurable adjustment anywhere on these line items, like from 2024 actuals. Is that right?
For RES, the only known and measurable adjustments that we included were for incentive forecasts as well as application fee revenue. And our estimated incentives for 2025 were based upon projects that were in service by the end of 2024.
Okay.
And then we did account for a change in the RES application fee that was approved in the annual review docket last year. It went from $129 to $163.
Okay. But for outside services, this would reflect the 2024 actuals?
Yes.
But do you know why in February there was this drastic, like it went from $10,000 to $330,000 for that line item?
Yeah, that was so contract staff are a separate line item. That's what I was discussing previously. We also have support from various specialized vendors. IT, basically licensed IT resources, as well as IT consultants that support a lot of the application portal activities, the design and maintenance and update of that portal. So a lot of, you do see one-time charges associated with things like annual licenses and then quarterly payments to consultants that support the program.
Okay. So do you think, did that jump maybe have something to do with like catching up from the prior year? Or, I mean, do you know why it's specifically February, like there was a massive increase in that cost?
I could speculate off the top of my head, but I'd prefer to look it up and make sure I give you an accurate answer on what those costs were.
Sure, we could take a late file on that.
Attorney Wheel, could you please summarize it? It's late file exhibit number 10.
Sure, the reference would be Exhibit 12 from the January known and measurable filing. And the question is to explain the increase to outside services costs in February. And then also May, there's another smaller but still substantial increase. So the February and May increases to outside services costs.
Thank you.
Thank you. So again, the original kind of trail that led us to this conversation was based on our interrogatory asking for internal O&M costs. So just to confirm, is what's calculated as internal O&M the labor and the contracts staff? Is it inclusive of the outside services line item?
So when you say internal O&M, are you referring to another exhibit or?
No, well, so we originally asked to just identify the areas within the public benefits category of bills that are internal operation and maintenance costs for the company. And the original response, so for RES, the original response gave us this total of 1.565 million. So I was just trying to tie, like I see that internal labor is 1.2 million in this exhibit. And then I was just trying to figure out like what, I think, I'll back up a little. I think our original question was asking for what was in rates as of July 1st of 2024. So these numbers, I presume, that would have been based on the 2023 actuals. So I don't expect this exhibit to add up to that total of the number I just said, 1.565. But my question is, what line items was the company looking at when it gave us that 1.65 million number?
Can I just confer with my colleague for a minute?
Sure.
So referring to Exhibit 12, which itemizes RRES costs. So the internal costs in that exhibit are going to be the top row, labor costs, as well as what's referred to as the RRES revenue requirement, which is the revenue requirement associated with the cost of system upgrades that were made to implement the RRES program.
Okay,
Those are the internal costs.
okay. No system upgrades are IT system upgrades?
Correct, yeah.
Okay.
Updates the billing system largely.
Okay. Why wouldn't the company consider contract staff to be internal O&M? Is that just because it's like not an internal employee?
Contracted staff is incremental to internal FTEs, correct?
Yeah, as I understand it, yes.
Yeah, I mean, we don't consider them internal FTEs because they're an incremental cost to the company. They're only hired as, whether there's staff augmentation issues, risks, concerns. So, individual departments such as Mr. Rice's organization make the decision whether there's a rise in responsibilities and therefore, those consultants, or in this case, staff, I'll call it staff augmentation needs are considered, and then decisions are made to bring additional staffing in from external.
Okay. Thank you. So I can move on to the NRES similar exhibit, which is exhibit 13.
All right, got 13.
Okay. I guess I'll start with the same question I just asked for, well, not just asked, but the similar question for RRES, which is the original response to OCC 5 gave us a $561,952 internal cost for NRES. Was that driven by like labor only at that? Because I don't see a similar like revenue requirement line in this document.
That would be correct.
Okay. So the labor costs for NRES have gone from that 561,000 to a little over $1 million expected for 2025.
Yeah, and I think a lot of that has to do with a reclassification. I think I speculate if you were to look at LREC, ZREC program costs over the same period, you'd see the opposite. And there was a kind of an update in the company's accounting to make sure we started attributing cost of ultimately the same staff to the new NRES program as opposed to the LREC, ZREC program that they had previously been supporting.
Okay. I also noticed that there's a jump in the labor costs again for March and August in this exhibit, which were the same jumps that for labor costs in the RRES exhibit as well. Do you know why those are similar increases?
My expectation would be that would be a result of the payroll patterns that we discussed.
Okay.
Because it typically happens in 2 months during the course of the year, and the NRES labor costs were otherwise more stable. So I think those jump out here more.
Okay. Thank you. People in my office often laugh at me for chasing after minuscule amounts of money, and on OCC 24, there is a $525 charge for Shrek listed for internal O&M, but there is no, as far as I could find, similar exhibit for Shrek, like where we could see a breakdown of costs. I just want to make sure I wasn't missing one.
I think I think I had a diligent analyst that made sure they recorded like the 2 hours of time, or more than 2 hours, but the few hours of time they spent on processing, the SHREC contracts each year. And I think we just made a decision that that was not necessary.
Okay. Would that analyst be also working on, is that someone from like the NRES team?
It would be, yeah.
Okay. Thanks. So exhibit 14 is SCEF. Starting with the same question again, the basis for the internal O&M calculation as provided originally in OCC 5, is that just labor for SCEF? There is a SCEF revenue requirement line item on this exhibit as well. Would it be the combination of labor and that line item?
My expectation is the cost would have been treated consistently. I didn't prepare the summary of internal O&M, but my expectation is the analyst that would have kind of pulled common items from each exhibit. So my expectation is that the internal cost would include labor and the revenue requirement identified for SCEF.
Thank you. There's also a line item for SCEF under general operations called other/uncategorized, and there's just this $156,000 charge in January of 2025. Do you know what that is?
Off the top of my head, I don't know. But again, we'd be happy to look it up. I don't know if it would be possible to incorporate that into your previously requested late file, or if a separate one would be more appropriate.
I would defer to the commission, I guess, whether that should be a separate late file. It doesn't matter to me. It is a very small question.
Let's just go ahead and make that late file exhibit number 11.
Okay.
Kenny, if you could restate, please.
Yep, the reference is exhibit 14. And the question is just to explain the other/uncategorized cost of $56,000 in January of 2025.
Thank you.
Could I also ask in that late file, again, because these were, this exhibit was prepared in January 2025, so I guess my other question would be like whether that was a projection or if that cost had already been incurred, like whether that was an actual when this exhibit was made or if it was based on the prior year. So if there could just be like a narrative explaining like if that's a cost that did happen in 2025 or if it was based on a prior year.
We'll confirm that as well.
Thank you. And I noticed the March and August labor bump here too, but I presume that would also be driven by the same overall payroll factors.
I expect so.
Okay. What are the outside services cost for SCEF? Like what are those, what are the outside services that are provided?
So again, with SCEF, we work with specialized service providers. We also license IT software, so some of it could be that. I know we expressly partner with an organization, Operation Fuel, that provides services to identify subscribers.
Okay. And I noticed a sort of pattern in that. I mean, it's like there's a $4,200 expense booked like every 3 months, with the exception of the very first month of January. Do you know like why they're generally why this expense only occurs sort of periodically throughout the year?
So I expect that the pricing for that service is on a quarterly basis. So the vendor is compensated through quarterly payments.
Okay. Could I just ask to add to that last late file for just more details about what vendors those are and just to confirm that there's like quarterly pricing?
Of course.
Thank you. Okay. So moving back, I guess, to OCC 24 supplemental response. What we just went through were the exhibits that were referenced in Exhibit 1, as we just discussed, but that response kind of only directed us to that for LREC, ZREC, SHREC, SCIF, RRES, and NRES. So are there similar breakdowns for ESS and IES and the heating loan program and the CLNM?
Yeah, are those in the exhibit? Or did we? Yeah. But yeah, they would be the labor costs for those programs.
Okay. I couldn't find, I saw there's Exhibit 22 in the known and measurable filing for ESS, for energy storage solutions. I might have missed it, but I couldn't find one for LREC, ZREC. Do you know if there is a breakdown, or is that maybe the consolidation you mentioned, Mr. Rice, that those are being put into the NRES line item?
So I think within the MB FMCC, LREC, ZREC, administrative costs are broken separately out from incentive costs. I know we provided a known and measurable adjustment for incentive costs. We did not provide one for O&M costs, so I mean that are for administrative costs, excuse me. So that may be why there wasn't a exhibit in the known and measurable filing.
Okay. So the separate breakout for LREC, ZREC administrative costs is just for labor, like so it's just a number of labor in the prior year.
So I was mistaken. We did include Exhibit 15 was the itemization of LREC, ZREC program costs.
Oh, okay.
Yep. And the only adjustment was for incentive costs.
Okay.
But yes, the administrative costs would consist of labor and potentially some outside service costs.
Okay. Moving to Exhibit 22, which is for energy storage solutions.
Yes.
What is IT integration and dispatch? What goes into that line item?
That's the systems to dispatch the customers, whether it's enabling Wi-Fi, thermostats, or other managed loads from the connecting to the DERMS platform.
So are those administrative costs incurred to do
Third-party
that?
vendor costs. Yeah.
Okay. So is that paying is that like a pass-through cost for what the vendor who's like?
Exactly.
Okay. So like if there's a storage project and that storage and there's some sort of third-party device on there that feeds information back and forth?
It would include device fees. Exactly.
Okay, understood. So the same question I had been asking before about like the basis for the internal O&M identified on OCC 24 supplemental, or originally OCC 5, would that just be labor for this?
Yeah, for the ESS, for the programs that are listed there, that's just labor, Eversource labor.
Okay. Thank you. Can you explain, just a quick question for the IT and integration dispatch. Do you know why there's this figure of $34,728, which is very exact, and that appears twice in 2 different months, but then the other numbers here are like the much rounder 25,000 and 15,000. Do you know like why there's that? I guess the question is, do you know what's driving the kind of variability in the level and frequency of that cost?
Well, this is for 25, so it's going to estimate based. So those were just rounded. These were estimates based on prior.
Okay, but what about the 34,728?
Yeah, I'll take that on late file as well. And just give you the breakdown
Okay.
of that.
Could I ask for a late file, Chairman?
Yes. Late file exhibit 12.
So that would be referencing Exhibit 22, and the question would just be to explain the variability in the IT integration dispatch costs. And I noticed, unlike my observations as discussed with Mr. Rice with respect to the other NRES, RRES, LREC, ZREC exhibits, the internal labor here is flat month to month. Is that because this is a projection?
Exactly.
Okay.
We use a number of FTEs and then divide it by the 12 months.
Okay. Is there not like a full prior year of labor to use as the basis for the 2025 projection? Is that?
Yeah, the assumptions typically are look at prior year and then include if there's going to be additional headcount added to that program. So that was the net of the prior year plus the estimate for what would be in place.
Okay. Thank you.
And we're also supplementing that with the other response I think earlier. I think the first supplement we got, we're going to compare 24 to projected 2025 as well.
Okay. Thank you. I was just curious, like we've been talking about kind of trying to, the underlying basis for this conversation was that interrogatory asking specifically for internal O&M, and I saw on the supplemental response on the response itself to 24, the supplemented for ESS, which is the very first line item, it breaks out IT technology support and customer incentives. The company doesn't view IT technology support and customer incentives as internal O&M, right?
No.
Okay. Next, I want to ask about Exhibit 21, which is for IES. And this one shows a single line item labeled labor and third-party support. So this doesn't distinguish between internal labor and external costs?
Yeah, this one actually has I mentioned earlier in the testimony today that this includes labor, it includes contract labor, third party, and also like evaluation, estimated costs and marketing acquisition costs.
Okay. And again, like we just discussed for ESS, these numbers, I actually noticed every number in this exhibit is flat month to month. Is that because these are all
estimates,
projections?
Yes.
Okay. Thank you. For Energize CT heating loan, the supplemental response to OCC 24 notes a $30,635 increase for 2025 for incremental labor for on-bill financing. Sorry, I guess I should have, I'm sure is there a heating loan, or is that you, Mr. Bruno?
Yeah, I have that too.
Okay, sorry.
Second. So it's and if you don't mind, can you repeat the question for the?
Sure. On OCC 24 supplemental, it notes that there's a $30,635 increase for incremental labor for on-bill financing.
Yeah, that one. Oh, yeah. Yeah, that's employee labor. So for the Energize heating loan, what's in that program, by the way, is sunsetted in 2024, but we have staff that support putting the loans actually onto the bill. So when a customer enrolls in a loan program, company staff enter the loan onto the bill, then reconcile with the third-party entity that's in the intermediary, because Eversource is not the originator and service of record, a third party is, so we have to interface with them. So it's that employee time.
Yeah, I was just curious about that because you mentioned just now and in the testimony, it talks about how that program's sunsetting. So I was just curious about, it just strikes me as strange to add new staff for a program where there's no new loans being added. Is there a reason?
Yeah, it's not, I apologize if that came across as new staff, that's existing staff. That's labor, it's already in place for the current program.
Okay.
So that number would look familiar in 24, 23, 22, et cetera.
Okay, I think I might have been reading into the word incremental in the response.
Yeah,
Meaning, but that means incremental, like to Eversource's base business case. Is that what then? Okay.
Yep.
Thank you.
And those loans, by the way, they go on for 10 years. So we still have to work with the lender and provide reports back and forth. Even though new loans have stopped, the loans are up to 10-year loan term. So loans that closed in 2024 will still be around for 10 more years.
Understood. Yeah, I understood the need for continued support.
Yeah.
I was confused because I thought it was like adding new staff, but I understand. Thank you. There's so Exhibit 10 is the breakdown of that program. And I can see on that exhibit, like that there's a downward adjustment as of April. You know, it starts moving kind of downwards it goes from 1.8 million in March down to 159,000 in April. So that's the removal of that's because of the sunset.
Exactly. And because there's a originator and servicer of record, we get charged a monthly servicing fee from that servicer. That's why those costs continue, but they're significantly lower than funding the loans themselves.
Okay, thanks. That was exactly going to be my question of why there's still that lingering 130,000, but that's the servicing fee?
Correct.
Okay, thank you. Are those costs, it's my understanding that that this is all part of, is the heating loan program dictated by the Energy Efficiency Board? Like, is that part of the budget for?
No, it was the energy efficiency team helps administer it, but it was a mandated program. And then the utilities were forced to basically create the program, and then they created a program and administered it. But it's done in conjunction with our program. So we work with the Connecticut Green Bank, the energy efficiency team, to make sure that we're not overlapping with programs.
Okay.
And I think its original purpose was for customers converting from natural gas.
Okay.
Converting to natural gas.
Yeah, I've just always wondered why it's not in the CAM, but that's why, is that it's not
not
within the CLNM budget. Okay, thank you. So speaking of CLNM, the last area that is identified as where the company incurs internal O&M costs within the public benefits category of bills is CLNM. So that response notes $13.675 million in administrative costs for that program.
Yeah, that's the employee labor for Eversource for the electric programs. And then that as you are correct, that's in the CAM.
Okay. So yeah, there is no, I couldn't find any support for that or backup for that number in this filing, but is that number evaluated in like the CAM proceeding every year?
Correct. We file the plan annually, actually twice a year with DEEP, and then DEEP goes through a process with the Energy Efficiency Board. Energy Efficiency Board approves it, recommends it to DEEP for filing, then PURA and the CAM proceeding for funding.
Okay. And I took a peek at the current docket, and that shows a motion showing a projected expense for this year of 146 million. Is that 14-ish million of admin costs within that budget?
Exactly.
Okay.
The brunt of the funding is for customer incentives to invest in energy efficiency projects.
Okay. Thank you. I can finally turn to the next interrogatory response, which is OCC 6, which pertains to IT. And it only identifies DER portal costs, I think. Nope, sorry. So that response references the DER portal, the DER map, the data dashboard, and LiDAR IT capital, although I don't think I have questions about the LiDAR IT capital.
We have that.
Okay. So I guess the first question is, are these all capital IT projects?
They're the revenue requirements associated with the capital. Yes.
Understood. Okay. So the first, for the DER portal,
Bless you.
gives me type. I saw the reference to docket number 170602 for the DER portal. And I saw in the final decision of that docket that the estimated cost of that portal was $2 million with an expected annual maintenance cost of $50,000. So is this $250,788 amount just the revenue requirement for the capital and not inclusive of maintenance costs?
I believe it would include the maintenance costs.
Okay.
We'd have to go back and check the schedule to see if the maintenance cost is on there, but I believe it is.
Okay. Do you know if the actual cost of the project once it entered service was around $2 million as anticipated?
I do not know that, but I mean, we could go back and look. We can go back in history and look. It was about 8 years ago now. We could go back and see if you'd like.
Okay. Maybe I might ask that because I have similar questions for the rest of the projects on here. So that I might ask for a late file of more than just this one. I couldn't find there's a breakout in Exhibit F, like Exhibit F32 shows the DER map cost, but I couldn't find anything pertaining to the DER portal. Do you know if there's anything in the RAM that shows a specific breakdown of these costs?
I believe the last year for the DR portal was 2023. It has now been fully depreciated, and so there would not be any schedule anymore.
Okay. Thank you. So as this response indicates, that makes sense, I should say, as a backup, because again, our initial interrogatory, which we've asked back in January, was asking about last year's rates. And this response shows, the narrative portion of this response shows that these are actual 2023 costs plus 2024 known and measurable adjustments. So if this project left service in 2023, why was it in 2024 rates? Was that because of a true up or?
I don't, I'm not sure. We'd have to go back and look at the 2024 rate setting filing.
Okay.
I mean, it would have been in there if there had still been depreciation remaining. If there had still been a revenue requirement required, it would have been in that rate filing. Otherwise, it would have been removed.
Okay.
Yeah, and Ms. Peruta just was showing me that in the supplemental to OCC 7 supplement 1, you can see the 2024 level of cost, which is 0.
Okay. So does that mean that the 2024 rates, the rates that were set like as of, I mean, I guess either July or September of last year didn't include any support for this project?
I'm going to assume yes, but we can go back and check.
Okay. Maybe, Chairman, if maybe I could just start a late file and maybe add questions to it as I go.
Okay, so we'll be starting late file exhibit 13.
Thank you. So I guess the reference for the late file exhibit generally will be OCC 6. And the first question is just, I think, to provide the date of retirement for the DER portal and then confirm whether and to whatever extent there was a rate impact for the DER portal in 2024 RAM rates.
So if I could, Chair, I can actually answer that right now. So in the rate setting process for July 1 of 2024, we did not have a known and measurable for that. So what would have been the rate setting, what would have been included in the cost for the rate setting specific to this particular cost would have been the costs incurred in 2023. And so and subject to check, but very, very likely, and what we can do that and do it at the end. Our known and measurable did not include it, which leads me to believe that it would have been included in the July 1 rates at the 2023 proxy used for 2024. Therefore, approximately $250,000 would have been included in the July 1, 2024 rates. Now, keep in mind, the 2024 actuals would have come through in this year's rate reconciliation filing, and therefore we would have had a reconciliation to take that additional revenue recovered in this year's rate setting process.
I understand. So maybe the question could be, unless you can now, could you confirm that the reconciliation this year does account for the crediting back that presumed $250,788?
That happens through the rate calculation. So to the extent there would have been revenue in the revenue line associated with, if there was $250,000 from the prior year's rate setting, that would be in the revenue line, but there'd be zero costs. So that would fall through as a credit and over recovery to customers.
Okay.
So Attorney Wheel, if I could, in our Exhibit F, line 45, as filed in the 250103 docket, page 3 of 33, you will see that the DER portal came through as an expense of 0. Now, the revenues, as indicated, would have reflected the 2023 cost as a proxy for 24. So in the July 1, 2024 rate, starting with your July-August timeframe based on, delayed in billings, it would have reflected a cost recovery for that estimate for the proxy. But at the end of the year and into the following year, you're going to see an over recovery because we included a 0 cost.
Understood. Thank you. So I can retract that question from the late file. So moving on to the DER map, that, as I referenced before, there's Exhibit F32, which shows a breakdown of the DER map costs. On page, well, I think it's the whole exhibit. I'm looking at page 2 of that exhibit, though, and looking at there's a line, it's Excel line 24, which says total DER map revenue requirement, and the total there is 34.375. Sorry, I guess that must be $34,375. But OCC 6 indicates $115,901. Do you know why those numbers are different?
Attorney Wheel. We were having difficulty finding that. I believe you're referencing Exhibit F23, not F32, correct?
23.
Okay,
Yes,
thank you.
Yeah, so I'm on page 2 of F23.
And what line are you looking at?
The bottom line, so row 24, I'm looking at the total cost of $34,375 in the line that says total DER map revenue requirement. And I'm comparing that to OCC 6, which shows a total revenue requirement of $115,901 for that.
But I believe we're off by a year, right? Like what's in OCC 6 is 2023 actual costs, isn't it?
Yes.
Okay, and what we're looking at here in F23 is 2024 costs, correct?
Yes. So
And Attorney Wheel, that would be in your Table 1 updated, which shows your actual 2024 costs. It's the second line item in your OCC 007 SP01.
okay. And the difference between that is depreciation? Like, is that why the cost changed from one year to the next?
Yes, that would be the primary reason.
Right, it's the full revenue requirement. So correct, as you're depreciating that asset, it's going to recover less in terms of return, and your full revenue requirements will begin to reduce.
Okay. Thank you. Do you know, it's a similar question to the question I asked before about the DER portal. Again, that is a reference to the same docket 170602. When I went back and looked at the expected cost for the DER map in that final decision was $300,000 plus an expected $20,000 in licensing fees. Do you know whether that was the or close to the ultimate cost of the project?
Yeah, no, we don't have that here.
Okay. So I think I finally have a question to fill for the late file, which is for both the DER portal and DER map projects, what the actual cost, the actual capital expenditure of the projects when it entered service was, and to also confirm the licensing cost for the map and the maintenance cost for the portal. Does that make sense as a question? Okay. Thank you. The next item on OCC 6 is the data dashboard, but that's another cost that's not in this current RAM filing this year. Is that correct?
Yes, I believe the data dashboard was ended, and there should be no costs in this year's filing.
Okay. Thank you. Okay, moving on to OCC 7.
We have it.
Okay. I noticed, I know that data dashboard isn't in this year's filing, but I noticed that it wasn't reflected on this, that the data dashboard is shown on OCC 6, but not OCC 7. Do you know why that is?
I don't believe that the data dashboard was a capital project.
Oh, okay.
But if I could, when you look at OCC 006 SP01, which was filed after our March 1 filing, in order to consider all of the data and information that we received, you'll see that in the table 1 updated, the data dashboard comes in at 0.
Okay. Thank you. So the data dashboard cost, was that just an expense every year when it was in rates?
Subject to check, believe so. We have the witness here. But subject to check, I believe that is correct. It was just an O&M expense that has since been terminated, and here he is.
Yeah, there was no asset produced for the company. It was a vendor hosted managed solution. So the company didn't have any asset. It was just an expense.
Okay. Thank you. Sort of a side question, there was some conversation earlier today about the capitalization policies. Does the kind of, because if there were internal labor, for instance, and developing that in addition to the vendor, couldn't the company have capitalized those vendor costs?
Attorney Wheel, do you mind just repeating the question?
Yeah, it's just, I'm thought of an answer perhaps after I asked it, but my question was why those costs weren't capitalized, because it's my understanding that just because it's a vendor cost doesn't necessarily mean that it can't be capitalized. But is the answer that the company didn't own the data dashboard?
So, and thank you for the question. That's a good question. So the data dashboard, and I'll have Mr. Trainer fill in where I fall off the rails here. The data dashboard was a dashboard that was being managed by an outside service agency, IT firm, whatever the case may have been. That was associated with an annual cost that was then billed to Eversource. What we have flowing through here is that annual cost. We do not own the IT infrastructure, so that is kind of your key distinction of what ultimately would be considered a capitalizable project or program where there's an IT upgrade in our infrastructure, as opposed to something that's being maintained and overseen by an outside consulting firm where they essentially own it, whether it's in their cloud or software system.
Okay, thank you. The next capital cost on OCC 6 is pertaining to the SCEF program. Do you know what that project is?
Well, Brian's coming up, maybe Brian knows. So that's the revenue requirement associated with the system upgrades to implement the SCEF program, which includes a unique bill crediting mechanism.
Okay. We were talking a minute ago about Exhibit 14, which is the SCEF known and measurable exhibit. And I thought that you had mentioned that the SCEF revenue requirement line item was because of an IT expense. Is that distinct from this capital project?
Attorney Wheel, can you repeat the exhibit again?
Yep, Exhibit 14.
So that does look like the same project. I mean, if you look at OCC 7 Supplement 1, you see that it's the 382,413 that's shown on the known and measurable schedule, Exhibit 14.
Okay. So that is the same project that's listed in Exhibit 14? Like these are the same costs, right?
That would be, yes.
Okay. Ready? Back to OCC 7. What's the Connecticut Solar Tariff Capital Project?
Yeah, so that's the same thing. We have a revenue requirement reported in the known and measurable exhibit for RS that corresponds to the line item in OCC 6 or 7? 7.
Okay. Thank you. And lastly, the new MPP IT capital, is that a project associated with facilitating the new MPP program?
Yes, it is.
Okay. Is this the first year that that's going to be in service?
Twenty 2024 was.
Okay. So because that, like, according to at least the original response to OCC 7, which was asking about 2024 rates, it wasn't included there. So was that project not in last year's rates?
So in the original filing, we did indicate to the OCC that we didn't have all the information available at the time, but that we would supplement it once the organization was able to gather all of the data. So because this went into service so late in 2024, once we saw the roll-in of all the detail come into our department, we saw that coming in, and that's why we disclosed it in our supplemental filing.
Okay. Thank you. I have a number of questions about the ESI, and then I also have some questions about uncollectibles. So that might make sense to ask the uncollectibles questions while Mr. Trainer's here. Does that make sense? Thank you. So we issued OCC 33 pretty recently, which was asking about the difference that we saw between the company's most recent compliance filing and the affordability docket, showing write-offs and the uncollectibles in the RAM. And the company's response notes that the uncollectible expense within Exhibit H reflects the change in hardship accounts receivable aged greater than 180 days. My first question is, the word change in that response kind of threw me off. It reflects the change in hardship accounts receivable age greater than 180 days. Can you explain what that means?
Yeah, so I think a part of what we're talking about is in accordance with PURA's historical order, and I think it's 150301, we were ordered to maintain the uncollectible expense based on the receivables aged greater than 180 days. So basically what we're saying there is that's kind of our indication each month from a journal entry perspective on how we analyze the data. So apologize if that was confusing.
So I understand. So the reference to the change is the monthly change in receivables.
Yeah, it's a part of our accounting process. So what we'll do each month is analyze that balance and evaluate where, the previous month was to help assist in the development of the journal entry and ultimately the uncollectible expense that's recorded each month.
Okay. So as we asked about in our interrogatory, we were looking at the difference between about 30.1 million, which is the total write-offs reported for the hardship designated customers in the affordability docket in 250501 versus the 52 million expense in Exhibit H, both for 2024. So is that $12 million difference, is that attributable to the difference between the 120 days and the 180 days? Because the affordability data shows only 120 or more days, or at least my understanding is the write-offs reported in the affordability docket are 120 days old versus it's 180 days for the RAM.
Yeah, so I think it's just important to distinguish the uncollectible expense that's established in the company's books and records for accounting purposes and a write-off. So from a write-off perspective, typically that is customer accounts that have, and Mr. Trainer can correct me if I describe this incorrectly, but customer accounts that have been written off, or sorry, have been terminated, whether that's their service has been terminated voluntarily or involuntarily. And they have remained, that balance has remained unpaid for 120 days. So that's separate and distinct from the cumulative evaluation of all hardship receivables, and that's both active and inactive customers for age greater than 180 days.
Okay. So what's reported in 250501 or other dockets is in the write-offs category is only inactive accounts?
That's correct. That's bills that have customers that have finalized out their accounts, and then it's written off 120 days after that final bill is rendered, if it remains unpaid.
Okay. The second question that we asked, and we appreciate that the company tried to answer it because I understand neither company can speak for the other's policies. I just want to explain the reason, like what we saw is that the distinction between the RAM number for Eversource and the affordability docket number for Eversource, it's the difference between $30 million and $52 million. And comparing the same numbers for UI, it was a difference like of over $100 million. So that just struck us. It was just that distinction that we felt like we were confused about, like how there could be that level of difference sort of as between the two companies. Does that, like, are you aware of anything that's different in the way that you're either calculating on collectibles or write-offs that would drive that kind of difference?
I guess to just talk through the response first, I think what we assumed the question was specific to RAM. Going through, and we highlighted this in our testimony last year as well. We have had some conversations with UI. We believe our accounting practices are aligned in terms of what's flowing through the RAM. They have a very similar order, which was from docket 210104, where they were also required to track. They use different terminology. I think they use the term charge-offs for receivables greater than 180 days, similar to the order in 150301 for CLMP. But I'm much less familiar on their filing in is it 250501? Thank you.
Okay. All right, that's helpful. So the response here discussing your familiarity with their accounting practices is specific to the RAM side and not maybe so much to how they're reporting in the affordability docket. Is that fair?
Yeah, at least the conversations that we've had historically has been more focused on, or at least that I've been involved in, has been more focused on the accounting side for the RAM proceeding.
Okay.
And I'm not aware of any operational differences between, once an account finals and how their process is similar or differs to Eversource's.
Thank you. So to be perfectly open, I guess, the reason for our questions is that we're just trying to develop a better understanding of how to anticipate the costs that, because we're able to kind of see, thanks to the company's information on an ongoing basis of what arrearages look like, and we're trying to get a sense of how to expect the rate impact of that. So the reporting in the affordability docket also shows accounts receivable 120 days or older. Would that be the measure of the active accounts?
Yes, that's only active, and active accounts and a subject to check. It may include inactive prior to written off. So in that, if you're, 90 days after final, you may be included subject to check.
Okay. Thank you. This might be a question for one of those affordability dockets, I guess, but is there a reason that the 120-day standard is the reporting standard for arrearages and write-offs, and the 180-day standard is the standard for uncollectibles?
As far as reporting and write-offs from a collections perspective, typically we look at 60 days when we're looking at delinquent accounts receivable. For that reporting, we bring it out to 90 and then 120. It just gives you different buckets to look at and see how much is rolling into each bucket. But we tend to look at a 60-day timeframe when we're looking at changes in AR and impacts from what's going on and seasonality and customer payment behavior.
Okay. How does the company determine? So I have the spreadsheet open from 250501 right now. I'm looking at December 2024 for write-offs and comparing and adding December 2024's 120 plus days receivables for hardship accounts. And the total for that is 218 million. And I was hoping that would be a decent comparator to what the actual uncollectibles were in 2024, but it's still pretty far off. So does the company have a better method for anticipating how uncollectibles how arrearages and write-offs eventually translate into uncollectibles? Is there an equation or some way to project what that will look like in a given year?
In terms of projections, or just how the calculation works from an accounting perspective?
In terms of projections, I suppose I just mean, does the company have some internal way of determining? I mean, we're aware the company constantly tracks the level of arrearages, and has an internal concern for the impact of those arrearages ultimately on rates, which happens here in the form of uncollectibles. So does the company have some way of determining, looking at the current arrearages now and write-offs, I suppose, what that it means in terms of what that indicates in terms of what the ultimate rate impact is going to be? Is there some sort of calculation that's possible to do?
There's a lot of variables that would go into it, so I don't know how accurate that would be. We can look at roll rates, see how much money is moving from bucket to bucket, and extend that 120 bucket out to the 180.
I do think, like Mr. Trainer indicated, there are a lot of variables at play there. Number of customers and hardship programs is one. Rate changes over time is another, and how that ages. Customer enrollment in payment plans and their activities in those payment plans and being able to stay in those programs is another. So I think it is one of those numbers that's unfortunately harder to project, just given the number of variables. And then you have other qualitative impacts like other economic factors in the region, in the state, and things like that as well, that also can play into how those arrearages can build over time.
Okay. Thank you. We can maybe continue this discussion in a docket where we talk about arrearages and stuff, but thank you. My next questions will be about the ESI.
Attorney Wheel, I think we should probably take a break if
Sure.
you have
Yes.
more than a handful of minutes.
Yes, and I can take some time to streamline my remaining questions.
Okay, let's break until 3 p.m., please. Okay, let's go back on the record and resume cross, please. Oh, Attorney Bidra. Yep.
Thank you, Chairman. One brief administrative matter. Mr. Rice has another commitment. I checked with the Office of Consumer Counsel. They do not have any further questions for him. If it's okay with the commissioners, if they do not have any further commissions for Brian Rice, we ask if he may please be excused.
1 second, please. He's the subject matter expert on NRES, RRES, SCAP.
Solar programs.
Okay. Okay, I think, I don't think the commissioner questions cover that, so he can be excused.
Thank you.
Okay, hello again, Tom Wheel from the Office of Consumer Counsel. My first questions are about the ESI testimony, the Glady Landro Torreno testimony. Looking at page 6. I suppose I could have asked this question without referencing the testimony, but line 7 says that there were $527 million in distribution plant additions in 2024 and $439 million related to core capital. We've talked about this the last year and probably the year before that, but can you remind me the difference between core capital and not core capital?
Yes, anything not core capital would be our system resiliency programs that we had documented previously, the IT project that you referenced before, and storm costs.
Okay.
We just checked the microphone. I'm sorry. Thank you.
Yeah, it was off. I can repeat it. Any difference would be the system resiliency programs that have been previously documented, any of the IT capital that are recovered under different rates, and any storm costs that get capitalized or not recovered through the ESI.
Thanks. And I think I asked a similar question last year, but the $439 million related to core capital of that, the company can recover up to the revenue requirement necessary to support up to $300 million. Is that correct?
That's correct.
And what has the company identified which expenditures of the $439 million in plant additions it's seeking to recover in this proceeding?
It's based strictly on time. So once we reach the 300 million on a calendar basis, that's the ones that are recovered.
Okay. So whatever enters at whatever point in time, the 300 million of plant in service, it occurs. Anything after that from the company's perspective is reserved for recovery and rate base in the next distribution rate case?
That's correct.
Okay, thank you. So I'm going to ask a question about a number of specific projects, and I'm going to kind of cross-reference between exhibits AA2 and AA3. I've identified them by like the line reference to AA2, and then I have page number references to AA3. So the first one is line 24 on AA2, which is CLMP DLOB. So referencing page 389 of AA3. My understanding is that this is like a program as opposed to an individual project, and this is for emergent work across the company's 14 facilities. Is that correct?
That is correct.
Okay, so this is made up of individual projects that are each less than $500,000?
Correct.
So going back to what we just talked about, given that the individual projects aren't tracked, at least in this exhibit, how does the company kind of snap the line between the, like, what's in service as of the date at which plant exceeds 300 million?
That would be based on the work order, not the project. There'd be a separate work order for each individual work activity.
Okay. Is it possible for PURA or OCC or any other party to determine within this program, like which individual projects aren't sought for recovery within this proceeding as opposed to being reserved for base rate recovery?
Yeah, we could provide this specific project by calendar month to show how much went in January through December of 2024.
Could I ask for a late file showing that for every program in here? Because I think there's, I think off the top of my head, correct me if I'm wrong, this isn't the only, I think that there's one for emergent work in the field. So similar like if we could just have a listing of.
So anything that's not a specific project?
Yes. Just so, again, to facilitate, to be able to tell, it's important to us to be able to keep track of sort of what was allowed in the RAM so that when we get to the rate case, we can keep track of sort of like what has already been reviewed versus what needs to be reviewed next, if that makes sense.
Okay.
So would that be late? I've lost track of the late file.
We're up to late file exhibit 14.
Okay. And did you need a prompt? So that would be, please identify the work orders, dates and dollar figures for all programs included in AA3. Would that captured? Does that make sense as a question?
For the annuals.
Sorry.
I'm sorry, for all the annual, just want to clarify. Yeah.
Yes.
Yep.
Thank you.
And the reference was AA3, you said?
Yes. So going back to a specific question about this program, that's the CLMP DLOB. So that's projects that are, it says, generally related to safety issues, building code requirements, security issues, and life cycle replacements, including furniture. Is that correct?
Yeah, this would be anything facilities related. Falls under that group.
Okay. And page 390 of AA3 shows a breakdown of authorized spend, but there isn't any kind of subcategorization of like showing those kind of subcategories, like safety issues, building code requirements, security issues. Does the company keep track of, does it like categorize these projects that way internally?
I don't believe we would have it monetized in that, by that category.
Okay.
Be by location, that's how it's broken out.
Okay. But for example, like if it's office furniture at a location as opposed to security upgrades at a location that would qualify for this line item, that's not categorized?
Yeah, I think that would be included on the work order if that was the case.
Okay. And in 2024, the total plant entering service here was 4.237 million. I'm pulling that number from AA2. Is that correct?
That's correct.
Okay. But again, as we just discussed, that might not be the total kind of sought for recovery here in the RAM because it would depend on the work orders that had kind of been completed by the time the 300 million total cap was hit?
Correct.
Okay. Line 28 on AA2 is referencing smart switch and eliminating 25R. And the AA3 reference is page 494. And from reviewing that, I understand this is potentially related to, potential outage risks.
That project's related to customers served out of some 5 kV substations that have no alternate sources. So if you had let's say transformer failure, there'd be no way of restoring customers. So those projects were converting those areas to a different voltage so they could have an alternate source.
In the event that there's an outage?
Correct. So if you have a transformer failure at the substation or any substation component, there'd be no way of restoring them. So those could be, substantial 10+ hour events.
Okay. Is this related at all to the smart switch projects that Pura disallowed in last year's ESI?
So there's smart switches included in this project. That's because the 5 kV circuits had like large groups of customers. So when they're converted, they're broken into our standard zones of 500 customers.
Okay. Moving on to line 32 of AA2, which is labeled WPC reliability improvement, which is referencing page 618 of AA3. My understanding from reviewing that is that this is like a worst performing circuit program.
That is correct.
Okay. And page 619 of AA3, the third kind of dash mark from the top references tree trimming at Beaumont Highway, and page 620 references outages caused by trees and vehicles. So I was just curious why this doesn't qualify as a resiliency project.
If tree trimming is done as part of a specific project, it gets applied to that specific project. The other tree trimming is just based on the miles that are cut over the year. So again, we have tree trimming on specific projects if it's done based on that the project need.
But my understanding from this project is that it's improving the performance of the worst performing circuits, which in part are impacted by tree and vehicle impacts. Is that correct?
Yeah, those are part of the reasons for the need.
Okay. So yeah, my question is just like how this qualifies as core capital, if the distinction between core capital is reliability versus resilience in addition to IT and the other and storm costs, as you mentioned before.
Our TDRP programs were approved under core capital, the worst performing circuit projects.
Okay. Line 33 of AA2, which is the Norwalk windows and facade renovation. That's described on page 638 of AA3. So my understanding is there's a water damage issue from failing windows. Is that the reason for this project?
That is correct.
Do you know how long that issue was an issue prior to this project authorization form being submitted?
I do not know that. I can find out, but
Okay.
typically they address the facilities group as issues like this arise. They do address them pretty quickly, especially if they're impacting the work center.
Okay. On page 639 of AA3, I saw that there's internal labor being capitalized and that it's escalating over time. Do you know why that would be? I mean, like, is our internal Eversource employees repairing the windows?
So that would be subject to check. So we could have internal folks that are project managing the work that's being done, but their time associated with that capital job, similar to prior discussions, would get charged to the work order and be incorporated as part of the capital cost of the job.
That's what I thought, but I was just curious, do you know why that cost would increase over time as the project continues?
I would think it's just because the magnitude of the work. So there must be, the first year must be the year that they're starting and then it ramps up.
Okay. Thank you. Line 46 of AA2 references the Windsor SOC renovation. And page 907 of AA3 says that the current Berlin CT COC is outdated and no longer fits the need for collaboration and future technologies required to efficiently carry out best practices. Can you explain what the issue is, like what's wrong with the current Berlin site that necessitates this new site?
I would, oops, I'm sorry. So, subject to check, I would have to confirm with the operations folks on that one, but I could find out. I do know there was space concerns, the screens that they use to monitor, but I would like to confirm that with them. I know there was an extensive discussion before this project.
Sure, if you wanted, to have a late file on that?
Yes, please.
Okay, so it would be late file exhibit 15.
It would be references exhibit AA3, page 907. And I guess the question would just be further explain the necessity for the Windsor SOC renovation and the issue with the Berlin CT SOC.
Thank you.
Line 53 of AA2 is the Gales Ferry project, and the AA3 reference is page 1020. And the first paragraph of that page, let me know if I'm trying to balance the need for everyone to get out of this room with the understandability of my questions. Page 1020, the first paragraph, second sentence says, this project scope is recognized as being necessary only as a result of the transmission reliability needs. Consequently, a distribution project and a distribution work order was required to purchase the cables and all associated material and equipment resources for this project. Transmission will journal all costs from the distribution work order to the transmission order. So my question, as I'm sure you suspect, is, are there transmission costs being sought for recovery in this exhibit?
No. This would strictly be distribution costs.
Can you explain why this seems to explain that this is, quote, only necessary as a result of transmission reliability needs?
It's a combined path, so it has both a transmission project number and a distribution project number. So the transmission costs are tracked under that project, and the distribution ones are tracked under their separate one. But the originating need for the project was based on transmission.
Okay. So if there's a project that is only necessary as a result of transmission reliability needs, but there are distribution costs associated with that project, those costs are booked to distribution?
The journal entry. Yes, this was a what we refer to as like a but-for scenario. In other words, there was no distribution work that was required, and it was only required due to the transmission work. So typically, we have to relocate facilities to perform their work.
Okay. Thank you. On line 63 of AA2, Rocky River TDRP, this may be similar to questions I just had about a similar project, but on page 1325 of AA3, there's a note at the top of that page that says, the expectation is to lessen the vulnerability of the system to outages mostly caused by trees while strengthening the infrastructure to become more resilient. I was, again, curious why this isn't classified as a resiliency investment as opposed to a reliability or core capital.
Yeah.
Yeah, this would be the same as the other circuit that you mentioned earlier in terms of it being a worst performing circuit under TDRP.
Okay. Line 70 on A2, which is central lateral reconductor, on page 1440 under executive summary. The first bullet says, due to high amount of tree-related outages, the initiative that is being done for each location is to reconductor bare wire with 336 TW. And the second bullet says, this will establish a more protected and resilient wire to prevent future tree-related outages. So same question, just don't understand why this isn't classified as a resiliency investment.
Infrastructure improvement.
It would be there because of the aging infrastructure, right? Not recoverable because of the, doesn't fall under resiliency because of the aging infrastructure.
This project wouldn't be under resiliency because it's the replacement of what we're calling aging infrastructure. It's older type copper conductors that are being reconductored, older poles being replaced.
Okay, so even if if the rationale for it is to increase resiliency, it doesn't get counted as a resiliency project if it's to replace aging infrastructure?
That's correct, because it's aging infrastructure replacement.
Okay. Line 81 on AA2 is called, labeled LC Modern Desktop. And the reference to AA3 is page 1620. It looks like this is a computer replacement program, is that correct?
Correct.
I saw on page 1621 that every line for removal net salvage is $0. Does the company not resell its used computer hardware when it's being replaced?
No, I don't think there's any value to it. Have to check that, but I get a lot of use, so I'm not sure there's much value at the end.
Okay,
But we can check that.
that's okay. I saw a reference on page 1620 to MacBooks. Does the company use Mac OS as a native operating system?
I'm sorry, can you give the page reference again? I'm sorry.
Yep, it's 1620. I'm double checking right now to make sure I have the right one in my notes.
We were doing a pilot.
Yeah, it's 1620. It's under executive summary, the second paragraph, the third sentence starts with, this objective will be achieved through 4 project tracks: modern management, the continuation of application automation and persona expansion, a Windows 11 upgrade phase 2, and the annual continuation of PC and MacBook deployment and retrievals.
So I'm aware we were doing a pilot, but subject to check, I'm not aware of any wholesale rollout of MacBooks.
Okay, so you're not aware of what portion of this project cost is for the purchase of Mac or replacement of MacBooks?
No, I'm not, but we could find out.
Sure, I'll take that as a WAV file.
Okay, so lay file exhibit 16.
The reference would be to exhibit AA3, page 1620. And the question is, I guess the question would just be, provide what proportion of, what proportion, if any, of the $4 million in hardware for this project is related to MacBooks? Line 85 of AA2 is the Berlin ATC building environmental assessment, I assumed what the ENV stood for. And that's on page 1682 of AA3. And on 1684, sorry to make you switch pages immediately, under alternatives considered, it says that just replacing the damaged area of the building will not create a tight seal to the building due to the ribbed profile of the metal siding. I was just curious if that assessment came from like a contractor or if if the company kind of independently determined that that wasn't an effective alternative.
I believe so, but subject, we could definitely confirm for you.
Okay. One more late file, Chairman.
Okay, late file exhibit 17, refer to exhibit AA3.
Page 1684. The question is whether the considered alternative of replacing the damaged area of the buildings was based on a contractor assessment or an internal assessment. And I've gotten to the last project, but I have a couple of questions about it, so don't get too excited. Line 105, which is called X-Tran Pilot, that's on page 1971 of AA3. This references leased LEAS-ED communication services that rely on old copper networks. Do you know if this is a reference to like the hardwired networks in the company's buildings?
I believe these are, I'm sorry. I believe these are the communication phone lines into the Eversource facilities.
Okay. Thank you. And I saw on page 1972 that the initial request for the project authorization form was for $446,000. And that was for a 2024 spend. And then compared to the AA2 cost of $608,000. So that's the first part of my question is I noticed that distinction. But then I also saw on page 1975 through 1976 that there's a supplemental request form that notes that $446,000 was approved, but $608,000 had been spent. I was just curious how that happened. Like at least according to the documentation we have, it appears that 446,000 was authorized and then 608,000 was spent prior to the request for additional capital. Is that normal? Like, is that a normal situation within Eversource?
Our process would be as soon as we project it to be 15%.
Right. Yeah. So to be our normal process is as soon as we are projecting a project to be exceeding 15%, we would come back in for a supplemental.
Okay. So 15% of 446 would be 512.9. So how did 608 get spent before the supplemental was filed?
Invoice came in.
It could have been due to a timing when an invoice, when they received an invoice for work and were made aware that they were exceeding.
Okay. On AA2, which is line 105 for this project, I see that the 2024 amount that entered service was 608. But I also saw that the supplemental authorization in AA3 was submitted on January 14th of 2025. So does that mean that the 608 in service in 2024 included amounts above what had been authorized?
That could be the timing when the paperwork was finalized or updated. These things can go through many versions.
Okay, but when a supplemental authorization is submitted, doesn't that require authorization at some point after that submittal before the additional spending is authorized?
Attorney Wheel, can I just add quickly, because it was at the end of 2024, it would have been in excess of the 300 million cap. So I just wanted to make that clear that the capital projects placed in service in 2024 would have fallen off of the ESI revenue requirement request that we've put into the docket today.
Thank you.
And typically, because I totally understand your question here. So we do have a series of work plan meetings, and I'm sure this was one of the items that was discussed. But given the circumstances, in many cases, there could be multiple circle backs on this if there's a question of what happened, why it happened. And that's what I'm thinking probably happened here, but typically this isn't the norm if that's what you're asking.
Okay. By typically not the norm, do you mean that normally there would be a supplemental request for funding at some point prior to the initial authorized funding?
Montaigne said is as soon as we're aware, that's when we would initiate the paperwork.
Okay. Is it normal for despite, I'll wait for Ms. Peruta, because I guess I had a question. No, you can, I didn't mean to call you out. I understand the point you made about that this isn't being sought for recovery in this proceeding, but this is booked to plant as of 12/24 in the company's books, correct?
Subject to check, we'd have to see if the fold-in into rate-based capital projects placed in service, because the supplemental that would have come in, I would have expected it for the entire project, right? Again, subject to check. I look to my colleagues here.
The timing of it too.
But to your point, Attorney Wheel, if it came into service at the end of 2024, then it would have been placed in service on the company's books and records in December of 2024, assuming it was a December date. So the ESI rate would have already exceeded the 300 million, so it would not have been picked up there, correct, to your point?
Thanks. I understood that. I guess my question was just, is it normal for the company to book a project to plant that is in excess of the authorized expenditure? Because as I just went over, this additional spend, this supplemental authorization wasn't even submitted until January of 2025. So is that a normal operating procedure?
So the normal process, so each one of our divisions has monthly capital review meetings where we have engineering, operations, investment planning, scheduling, go through the projects, review the current status of the projects, what percent of the work has been done versus what's been spent. And that's what triggers the need for supplementals. So it's a monthly review meeting that occurs in each division.
Okay.
That's like the normal process for triggering the need for a supplemental.
Okay. Thanks. That was OCC's last question for this panel.
And Attorney Will, can I just add one thing there, just to follow up, because I did get the answer to your question. It did go in service on December 30th, 2024. So it was at the end of the year.
Thank you.
Thank you. We'll turn to Commissioner questions. Commissioner Karen. Thank you. Commissioner Conti.
Good afternoon. I had a quick question on LMPs. Right, okay. So I'm on RU10, and when you get the information on these forecasts from OTC Global Holdings, are you also provided a narrative response from the company explaining the rationale or their circumstances for the projections?
No, we're
No.
not.
Okay. How come?
How come?
Yeah. I was gonna ask for potentially a supplement, if you had that information. I'm just kind of curious for our understanding of these projections as well.
Yeah, I'm not sure the reason why we don't have that information. I mean, generally, I think this is also on the record from our prior hearing. Generally, it's related to gas prices and projections as they pertain to gas prices, et cetera, et cetera. But I don't know if it has to do with, subscriptions or the level of information that we receive or don't receive, or, if it's just generally not provided. I don't know the answer to that.
Okay. Thanks. That's
Sorry.
That's okay. I wasn't expecting that answer. All right. I just had a couple more follow-ups on just energy efficiency, if that's okay. And then that's it for me, Madam Chair. So my question is, quickly, would you be able to give me like just a quick 101 on how the performance management incentive works for the company?
Sure. For in energy efficiency in our plan filing, we have exhibits that explain it, but essentially the majority of the performance incentive is based on the system's benefit. So basically you have to manage your spending goals, and there's also savings goals. So there's a sliding scale from based on, 70% to 135% and a performance payout. 80% of that payout is based on how you perform versus goals, saving MMBTU savings, kWh savings, therm savings, and fuel oil as well. And then 20% is other metrics like number of homes that you insulate, number of customers that are in EJC territories. There's 20% that's based on secondary metrics, 80% primary metrics, with the brunt being managing to get the savings goals that are prescribed in the plan.
Okay. And how does the incentive flow back to the companies? What's the mechanism?
It's part of in the overall budget that's in there. It's part of the overall budget. So the company's budget in the performance incentive, a line item for that. So out of the number that was mentioned before, like $48 million, there'd be a budget of say 5%. And then that number that's actual could be either less than 5% or more than 5 up to the thresholds.
So the CAM, the budget flows through the CAM. Okay.
Exactly.
And who approves the conservation land management budget?
So the first step is we work with the Energy Efficiency Board consultants, and then that gets presented to the Energy Efficiency Board. They're the first round of approval. Then after the Energy Efficiency Board, the plan gets submitted to DEEP for review and approval.
Okay.
And
all
then
these costs flow through public benefits.
Correct.
Right. And energy efficiency subject to check is roughly 20% of that portion of customers' bills.
I don't know about the 20% on that piece. I know you're talking about on a customer's energy bill, how much is for energy efficiency?
Yes.
It's 6 mils, 6/10 of.
Well, I meant as a percentage of the public benefits charge, I suppose.
Yeah, I don't think I know that percentage.
Okay.
We can do that.
That's okay.
No.
All right. Those are all my questions. Thank you. Yes.
Hey, just to elaborate on your earlier question, were you asking about the projections or the actual LMPs?
I was asking about the projections.
Okay.
Like, do they give you a narrative on the actuals?
No, I mean, the actuals are just based on
Okay.
energy and the transactions that occur. So I just wanted to clarify that. Thank you.
Thanks, Madam Chair.
Great. Thank you. I do not have any questions. So does the company need a moment to consider redirect?
Yes, please.
Okay, we will recess for 5 minutes.
There's still the question of how much is that?
Hopefully it doesn't open up.
Okay, Attorney Bidra, when ready.
Very briefly, thank you. Mr. Davis, did you hear Commissioner Arconti's question about how much of the public benefit charge energy efficiency compromises?
Yeah, I did a quick calculation just for your reference. So I was looking at a rate 5 heating customer on about 10%. But a regular rate 1 customer were about 15–16% share, energy efficiency share of the total public benefits at current rates.
Nothing further. Thank you.
Thank you. Okay, with that, then let's just recap. Attorney Bidra, according to my records, we have 17 late files. And then I recorded 3 supplements. There's not going to be an entry in the case management system for them, but I just want to cross-check our records. And I'd say that the late file exhibits are set to be due on June 4th, 2025 by 4 p.m. Did note in the conversation this morning that one of the 3 supplements, I believe the supplement to RRU 10, the company requested or until June 13th to provide that. So that would be the exception. So if that matches your notes, unless there are any administrative matters from the company or parties or interveners, I'll pause. If none, then I want to thank everyone for their participation today, and we are adjourned. Thank you.